Hello and welcome to Real Deal Investing, the channel dedicated to educational and informative content on real estate investing, both for experienced real estate investors as well as people who are thinking about getting into real estate investing. I'm Jerron Kelley, your host. I'm a real estate attorney as well as a multifamily real estate investor. My co-host here, Larry Mastropieri, he's a real estate broker as well as a multifamily investor. We welcome you, and today we have an awesome guest. We're excited. Hi, Jay.
Hi, how are you?
Good, thanks. We've got Jay Krigsman, who is not only a client of mine, but he has also become a friend. Jay's a great guy, very educated, very experienced in the real estate industry, both in multifamily as well as commercial real estate. We're excited to dive into your experience and your knowledge here. Welcome.
Thank you. I'm looking forward to this. So thank you very much.
Good. Thanks for coming. So I always like to start off these kind of podcast interview style with just getting a background. Why don't you tell the audience and the viewers just a bit about you, kind of where you're from, how'd you get into real estate, and we'll dive deeper in after that.
Sure. Well, I was born and raised mostly in New York, a little bit born in Brooklyn, but moved out to Long Island when I was a young kid, and typical Long Island childhood. And I was always had to work. You know, my parents were divorced, and early in life, I just had to, working was something I did since as far as I can remember. And one of the jobs I had as I got older was believe it or not, I was a cabana boy at a beach club.
Nice.
Think Flamingo Kid.
Flamingo Kid, good movie.
I was a cabana boy at a beach club, and the great thing about, it was a hard work. It was 6 days a week. It was 12, 15-hour days. But on Monday was our day off. But on Tuesday, Wednesday, Thursday, it was much more quiet because for the most part, back in those days, you could say the husband was at work, but for the most part, the worker in the family was at work on Tuesday, Wednesday, Thursday. They would show up mostly. The weekends got busy, but on Tuesday, Wednesday, Thursday, it was just very quiet. I had to be there anyway, but I did a lot of reading. The other thing that I kind of thought I was enamored with was the amount of money that these people had, and they would just at the end on a Sunday mostly work for tips. Just people would pull out wads of, and I'd be like, what do you do? And it was interesting. It was most of these people at that point in time were Wall Street. This is mid-'80s. This is when Wall Street was just crazy, and the penny stocks and the just all that stuff was going on, and people were just making a lot of money. And so I thought, okay, well, that's what I want to do. That's kind of how I started to think of that's what I want to do. And I did, like I said, I was doing a lot of reading. I'd read Money Magazine, Wall Street Journal. And actually, in one of these magazines or in the journal, there was an advertisement that was kind of written like an editorial, an advertorial, whatever they call those. And it was a guy who wrote a book about buying real estate with no money down. And it wasn't Robert Allen, that's the one that everyone thinks of. Sure. It was a guy named Mark O'Harrelson, of all things. And I sent away for the book, and I read the book, and which then made me read Robert Allen's book and so on. And I was just fascinated by the creativity of the kind of deals you could do in real estate. Mm-hmm. And so my tagline wasn't so eloquent back then, but I kind of thought, okay, I'm either going to go Wall Street or Main Street. That's kind of where real estate or
yeah, that's good.
Yeah, I didn't have that then, but now when I'm telling the story,
Looking back on it, that was your
Wall
tagline.
Street or Main Street. And I must have told my mom or somebody, and my mom was a working mom, and she had a client who said, well, if he's going to go into real estate, no offense, Larry, but she said, if he's going to go into real estate, he's got to go commercial. If you're, and again, no offense to any of the realtors out there, but this is just the path that I took, is he said, he told my mom, if he's going to, if you work in selling single family homes, you're working when everybody else isn't, because your client can see homes and talk to you in the evenings and on weekends, and then commercial real estate is actually more of, let's just say, where the money is. I didn't know what commercial real estate was, but okay, and I started looking into that. And what I learned in both cases, Wall Street and Main Street, it was as true then as it is now, is if you don't know somebody in the business, it's really hard to get into that business. Mm-hmm. And I didn't know anybody in either place other than all these guys that I worked for, at the beach club.
And I don't want you to lose your train of thought here, but I just had to piggyback off this. On the way here to the podcast, I was on the phone with Larry, and every time I call Larry in the evening or in the morning, his phone goes straight to voicemail. And I said, Larry, hey, how does that work? He said, I got a feature on my phone that at a certain point I can turn it off, because he said a lot of people are abusing my time. So getting back to your point, being in the residential real estate space, it's definitely a lifestyle challenge, right?
When you said that, I was like, I resonate with this, and I'm
smiling
living that
inside.
life. Yeah.
Exactly.
So anyway, sorry, but back to commercial. Yes,
and actually, eventually, in the life that we're going to get to, and even on the commercial side, there's a lot to be said about, today they call it work-life balance. We didn't know what that meant back then, but there's a lot to be said about that. To some
Absolutely,
extent.
Yeah. I had to adapt to what this was one tool that we used to kind of create that balance, because I was getting burnt out. I work with clients in California, I have clients in Israel, we have clients all over the place, and they're just like calling you at 1 a.m., or at 10 p.m. at night, which is just like, I got to turn it off in order to perform the next day, right?
Yeah.
So,
yeah. Agreed.
So anyway, to try to make this long story shorter, I had to find my way in. And so I, again, going to date myself, but I literally, first of all, I realized I couldn't force my way in to any place that was Wall Street related. First of all, I was in college at University of Maryland, so I wasn't in New York at the time. And while there's plenty of Wall Street related businesses in Maryland, they were more like stockbrokerages. And back then, you had, Shearson Lehman, Merrill Lynch. There were these literally offices where your stockbroker was. It wasn't Fidelity and Schwab, and those guys needed someone like me, if they needed someone like me at all, during market hours while I was in school. And so I couldn't really figure that out, how to figure that out. But with real estate, I said, I can go after class, I can work in the evenings. If I have to work on the weekends, I'm happy to do whatever I need to do. And so I literally, and again, for the young ones here, you're not going to know what this is, but I opened the phone book. I'm not kidding you. I opened the phone book and I called every commercial real estate brokerage firm in the D.C., Maryland, Virginia market. And that kind of the DMV, they called it. And amazing. And the pitch was, look, I'm in University of Maryland. I really want to get into commercial real estate. I'll come work for free. I just want to learn. I don't need any money. And amazingly, how many people said, "Sorry, we don't have any.
Wow.
We don't have anything." I was shocked.
Yeah.
But fortunately, one did, and I went there and I became an intern with a company that was predominantly known as a tenant rep firm. So they represented tenants, people who leased space. It was a company called Studley, or Julian Studley, New York-based company. They're national. They're actually international now. And at the time, they predominantly represented the tenant. So if a law firm or an insurance company or whatever needed 10,000 square feet of office space somewhere this office was in the Northern Virginia market, somewhere in Northern Virginia, you could call off the sign and deal with the broker or deal with the landlord, but that broker on that sign or that landlord represents the landlord. The pitch at the time used to be, just like if you were getting a divorce, you wouldn't let your wife's attorney represent you. You need a broker to represent you on the buy side, on the leasing side. And we were tenant rep brokers. And it was great. It was 100% commission. Actually, at the time, I was an intern. And what really happened was, just to try to keep the story short, but I was graduating, and all my buddies were getting their resumes done. And I remember, I didn't have any money. I remember, asking one of the guys in the office, you think Jack, who's the manager of the office, you think he'll mind if I ask Marcia to type my resume for me? And the guy was like, well, what do you need a resume for? I said, well, I'm graduating. He said, they'll hire you here. I mean, so I was like, oh, I never even thought of that, because I always thought I was going back to New York.
Got it.
And so I said, yeah, you know what? One of the lessons that I learned early in life was it's always easier to find a job when you have a job. Mm-hmm. And so I said, okay, I'll take the job. I'll start working at it. I'll do a great job. And then eventually I'll move to New York. It was always eventually going to go to New York.
Got it.
Worked it for a while. And one of the great things back then, this is 1987 now, believe it or not, and it seems so long ago now, but it really isn't. But in 1987, there were 2 computers in the office, only 2. There was the word processor, had one, and then the research department had one, and I was in the research department. And so while I was an intern, I taught myself how to use the computer. I taught myself WordPerfect, which doesn't even exist anymore. Now we have Word. Sure. And I taught myself Lotus 123, which doesn't exist anymore. Now we have Excel. But I knew how to do that. And what was
created value.
What happened was, as soon as computers started to become in the mainstream, all these brokers in the office, they couldn't show up to a pitch to try to represent, AT&T for a 100,000 square foot requirement and not have a spreadsheet. Mm-hmm. But none of them knew how to do a spreadsheet. So they, hey kid, come here, help me do the spreadsheet. We'll put you in on our deal.
Put you in.
And so I started doing that, and to try to bring it to an end, one of the guys in the office one day calls me aside and he says, hey, I'm thinking of opening an office for the same company in Orange County, California. I'd like you to come with me. I'm trying to get to New York. What the hell?
This is the opposite direction. Yeah.
But I did. I took it, and I thought I'd go out there for a year.
Yeah.
The joke I have now is I tell everyone I went to California for a year and I stayed 30. I actually stayed more than 30. That's the irony is I'm 58, and so my wife always says when you tell people you're from New York, you're not from New York, you're from California. You spent most of your life in California. It's an interesting point, but when I still like to say I'm from New York.
Yeah, got it.
But went out there as a broker, and I realized one of the things I did realize as a broker is there's a lot I don't know, and the problem I had as a broker was Studley. Studley was very much at that point in time a sink or swim. Just figure it out. And there was a lot I didn't know. I didn't know when the landlord pulled out that funny-looking calculator and started doing things. Not only did I not know what that calculator was, I didn't know how to use it, and I sure as heck didn't know what the numbers meant. So I said, I have to learn how to be on the other side. And so I was fortunate enough to find a job with a local developer in Orange County, California, a company called Bircher. And they were in the process of developing a little over 1 million square feet of a mixed-use project, Class A office, a whole bunch of what's called flex R&D space. So it's kind of like industrial space that's got a lot of windows and some offices and is more like labs and a creative space than it is what you would think of as industrial space. It's called flex R&D. A couple of little support retail centers, and there was a hotel. And I was going to handle the leasing for the office and the flex R&D, mostly. A little bit of the retail, but not much. I got to learn how to think like a
calculator
landlord.
guy.
I became that guy. I got to understand that, which is very valuable for. I mean, the knowledge that I learned then, and we'll talk about that a little bit. And the interesting lesson that I've learned, as I tell people, I'm kind of jumping ahead for a second, is in commercial real estate and multifamily if you're 5 units or more, is considered commercial real estate in the lending world and in the investing world. If you're more than 4 units, it's considered commercial. So the idea that if commercial real estate means it's a high-rise office building or it's a shopping center is not necessarily true. And the reason I say this is the fundamentals, the formula, and the way that you operate commercial real estate is exactly the same, whether it's a 60-story Class A billion-dollar office building or a 10-unit, 2-bedroom, 1-bath apartment building.
You're just adding zeros.
It's just adding zeros, and we could talk about that in a second. Yeah. But to finish the story, I ultimately was fortunate enough to, and there's a lot of story in between, but fortunate enough to meet a man named Amos Krause in California, who was the patriarch of a very successful, I'm going to call him family office. They didn't call them family offices back then either, but it was he had a very nice portfolio of real estate that he and his family created from scratch. I mean, he was when before him there was nothing in the Krause name in real estate, so he really created it, and he needed someone like me to come in and help them with their leasing and then ultimately the management. And still to this day, I'm now a partner, a principal in what's called the Krause Companies LLC, and also have equity and ownership in not all of their deals, but a good part of their deals, and I'm on the decision making side with them. So I've been with them for about 30 plus years, and still they're my Amos unfortunately has passed away, but son and daughter and now grandkids and even in-laws are in the business, and they're family to me. I mean, they are absolutely and good friends.
They trust you, obviously, and you become a trusted advisor, like a family member. And were you, or are you, the only non-family member that's a recurring partner in these deals? Would you say?
Yes. As a matter, yes, I am. It's there was a chemistry from the beginning. I used to in the days when I would work directly with Amos, when I got hired, many of the kids who were still very valuable to this day and were active in the business all had other things they wanted to do, and so they went and did them successfully, which is great. But for a long time, it was really just me working directly with Amos, and we joke right now that thank God it wasn't today, and we would need a big insurance policy, because we would call each other every day to tell each other dirty jokes. It was that kind of a relationship, and he would invite me, my wife, my kids. We would go. We were in Orange County, which would be like you being in Jackson, 5-hour drive. So like you being in Jacksonville or somewhere else, and saying, hey, come on down to my house in Boca. He would have us, my wife and my kids. We would get invited to their house for the holidays, because my family was back east.
It was in San Francisco.
He was in San Francisco. I was in Orange County.
Drive,
yep. But it was family.
Good times.
I mean, it was family, and so there was, and now of course I'm that way with the kids as well.
And they were mostly in what types of deals were you working in? Without getting too deep, we'll get back into that.
When I started with them, it was predominantly Class A office, but either ground up development Class A office, or the pitch I usually like to tell someone when I talk about Krause is we either develop or we redevelop commercial real estate. And so many times you find assets that are just, distressed seems like such a terrible word, but just not being run properly. And you can go in there and add value. And so we would develop ground up, Class A office buildings, but we would also buy lots of, we bought an office building from the RTC, if you remember what that was. That was the first financial commercial real estate crisis, and the federal government created something called the Resolution Trust Corporation to own all of these real estate, commercial real estate properties, many office buildings that were just from bad loans that went bad. We bought a building from that. It was Class A building, but it was just not being run properly. And then there was some retail. Amos started in the retail world, which is a whole nother story for another time, but he has some fascinating stories about his success that were just creative, and maybe in 2023 would be considered not
possible.
Not possible. That's a great way to put it. Not possible, but back then they very much were. I mean, as an example only, he tells me these stories that he used to tie up real estate with a check that was not good. And on the check he would write, "To be used as an instrument." It was a sign of good faith. And then he would tie up the real estate. And then he would go and find a tenant. And back then, today you have 15 days due diligence, 21 days to close. You don't have time to breathe. Back then you could tie it up for 90, 120 days. And then he would go find a tenant, and with a handshake, then he'd go to the bank and he'd get financing. It's just amazing. Things today you can't even get in front of the bank.
My parents, the bit of multifamily investing they did in the 70s and 80s, they build and develop some small apartment complexes here in Palm Beach County, but they explain stories of they would just literally have relationships with the lender at the bank. They'd walk in, Mr. Smith, Mr. Johnson, whatever it is. Okay, show me what you're looking at here. They'd have just, a little sheet of paper with some numbers and this and that, and it's a handshake, and let's get it done.
That's one thing Amos Krause taught me a long time ago.
Relationships. I mean, it's
it's
still important today. Relationships.
Oh, it's
still
extremely important. And a handshake.
There's a lot more paperwork nowadays, but
a handshake is as it should be as good as a signed contract if you want to have integrity and people. Because one thing I also learned is, in this business, people, you establish relationships and people learn to like you. But people don't necessarily remember the really great thing that you did for them 5 years ago, but they never forget if you screwed them 5 years ago
100%.
or if you lied to them 5 years ago. And so
Takes years to build a bridge and takes one moment to burn one.
So Amos always taught us, I mean, if he agreed or shook hands with somebody and then walked out of the room and realized he made a mistake, he might actually go back and say, can we fix this? But if they say, no, that's the best we could do, he's like, well, we agreed to it. We got to live by it. That was he always stuck to his word. And that's one thing he taught me, which was important.
That is important.
So anyway, so that's how I got into commercial real estate. And actually, to just finish the story, most of what I did from when I joined Krause until 2011, and I'm still with Krause, but until 2011, most of what I did was 100% commercial real estate owned by and with Krause. And in 2011, I started to build a little bit of my own portfolio in a way that was not in any way competing with Krause, and they knew about it. Sure. And that actually happened because, to kind of show you how the Main Street and Wall Street stories come back together, when I was with Krause and I was doing real estate with them, I would still trade in the market. And I wasn't a day trader, but sometimes it was a week trader or a month trader. Sometimes it was a day trader, but I was a trader. I wasn't investing, put money in an index fund and not worry about it for 30 years. I was trading. I was buying a stock here, selling it here, buying it back here, selling it here. And the short answer of that whole thing is I did really, really, really well until I didn't. And in 2008, 2007, 2008, when that, I didn't. I lost a ton, and Krause actually was very supportive of me back then too. There was no secret here. I got hurt. I started to realize, okay, my mistake. I over leveraged. I used margin. I was maybe getting a little bit too greedy in what I was doing. So I said, I have twin girls I have to put through college, and nobody's going to pay for this but me, so I better figure out how I'm going to do this. And of course, I had Krause and my salary there and some of the equity, but I needed to do more, so I said, okay, I could do this again. I'll just be more careful. And I started trading again more carefully. And then in 2010, the talking heads on CNBC were talking about Italy and Greece defaulting on their debt. And they said, if Italy or Greece, forget Italy and Greece, if Italy or Greece were to default on their debt, it's going to make 2008 look like a birthday party. And I was like, I can't do this. I have a family I have to take care of. I can't. What I learned at that moment, at that exact moment, was that no matter how smart you are, no matter how good you are, no one person truly, and I'm sure you could point out other people like a Madoff or a Milken or whatever, but they also eventually get into trouble. But no one person can really control the stock market. But you can control your destiny with real estate if you do it right, and I'm sure we'll talk about that. So I said, I got to get out of the market, but I have to find a way to invest my money. And so I said, what can I do? And the only thing I could do was real estate. That's the only thing I really knew. I couldn't start buying real estate that would be a conflict in any way with my family at Krause. So that really, then they did all types of commercial. We do industrial, retail, office, flex R&D, corporate campuses. But what they did not do was single-family homes or multifamily. And we could talk about this a little bit too, but to me, single-family homes are a job, not an investment. An investment in real estate is not about flipping a house. If you flip a house, you buy a house for $200,000, you put $50,000 into it, you sell it for $325,000, you made some money, but now you got to do it again. That's the job. What you really want to do with commercial real estate is develop a stream of cash flow, I think. I know some people think it's all about the appreciation. I think the appreciation is the cream, and the cash flow is the reason you buy, and we could talk about that as well and how the formula works. And it's a pretty amazing formula how cash flow creates appreciation, as opposed to, well, the house down the street sold for $400, now sold for $450, so the neighborhood is now worth $450. That's kind of market appreciation. And the problem with market appreciation is no matter how well you fix that house up, you're never going to make it worth too much more than the neighborhood. Yeah. You might set the new high comp, but you're not going to blow it out of the water.
You're anchored by the other 50 houses in the neighborhood.
Playing the market appreciation game is like speculative, right?
Right. It's very speculative. Yeah. And you should never, and I try to teach this to young people right now who talk to me, is you should never factor appreciation into your deal for the deal to work. Appreciation should be part of your deal conservatively to maybe see what your major profit might be, your full internal rate of return might be after 5 years. I have hurdles that I set, and I'll tell you about those too, which are hard to do these days. But appreciation shouldn't be the reason the deal works. If it is, you've now set yourself up for failure.
We call that, like me and my partner call it, like the get lucky factor. Like how lucky can we get here? And then like, does the deal work today?
Right.
Right.
It has to work today. Yeah. And it should cash flow.
Yeah.
Or if it doesn't cash flow immediately, you should have a very, very short path to creating cash flow, because that's the lifeblood is cash flow.
And the reality is that's how we've been doing it quite a bit over the past few years. You're buying stuff that maybe doesn't work in place, but the pro forma works as long as you know how to stabilize it. Sure. Right. Yeah.
Right. Yeah. Well, so I realized I didn't want to do single family homes, so multifamily. And here's the next lesson in this, which will kind of get into what I've done now to build my portfolio, is I started to look, even though, to go back to Amos Krause for a minute. Amos, we had a 26-story high-rise office building in Phoenix, Arizona. That at the time it was built, it actually used to be it was the tallest building in Phoenix. It was called Prudential Center at the time, or Prudential Plaza, something like that. Prudential occupied most of the building. When we bought it, it was a very, very distressed asset. It had the joke was the asbestos had asbestos. I mean, it was just teeming with asbestos. Nobody, back at that moment in time, insurance companies were like, get rid of anything with asbestos. So Amos bought it right, and we went in there and we renovated it and turned it into a Class A building. But without getting too much into that, the lesson was that rather than chase every deal, Amos made the decision that we have all of these big chunks of space. Let's only go after the big deals, because there's lots and lots of guys looking for 2,000 feet. But and if you're looking for 2,000 feet, there might be 400 choices. There might be 10 choices in the same building. But if you're looking for 100,000 feet, there might only be 10 choices. And now we can...
And there might only be a very handful of players that are in that.
Right, but that's what he... But he said, go for the bigger deals. And that doesn't exactly translate into what I learned in multifamily, but you'll see how that's why I brought that, how the segue is when I started going into multifamily, the mistake I made originally, and fortunately the universe didn't let me make that mistake, was I said, even though I know the formulas are the same and it's commercial real estate, and I'll start with like a 6 or an 8 unit, and this way I can't hurt myself too much. And so I started looking for 6 and 8 unit deals, and I actually stumbled on a 40 unit deal.
Riviera Beach, right?
No, this is in California still.
Oh, this is California.
I am
still.
in Orange. Okay. I'm in Orange County. This 40 unit deal was in San Diego.
Okay.
And
this was your first multifamily on your own?
My first multifamily deal.
Okay.
And it was 40 units. And at this point now, remember, I know how to use the calculator. Yeah. I had actually since then gotten my CCIM designation, which is a certified commercial investment member, and it's a great designation. It's not easy to get. It's kind of like an MBA in real estate, but you learn a lot about how the numbers work, which is great. There's lots of other ways to learn that without having to go through it. The numbers are, believe it or not, if I explain the numbers, it's really simple. Mm-hmm. But I ran the numbers on my calculator, and didn't even use a spreadsheet, and which, by the way, another very, very important rule is if you cannot run the numbers on the back of a napkin and make it work on a napkin, it doesn't work. Because it really, you can expand on it and do all these complicated spreadsheets, but if it doesn't work on a napkin, you don't try to talk yourself into the deal. Don't
waste your time.
And the napkin formula is really simple. So I'm jumping to another thing, but the true underlying, where all commercial real estate is the same, we were talking before. Mm-hmm. And so I'm going to jump away from my thing for a minute and educate for a second. But all commercial real estate is valued based on, there's lots of ways, but one of the primary ways is a cap rate applied to the net operating income. And the simplest way to explain a cap rate is if you paid all cash, what is your interest rate? It's not return of investment, it's return on investment. So it's kind of like if you went to the bank and gave them $100,000 and they were going to pay you $5,000 a year in interest, that would be a 5% return on your investment. That's a 5 cap. Mm-hmm. If they gave you $10,000 in interest, that would be like a 10 cap. Mm-hmm. It's really that simple. And so now you're getting into the difference between commercial real estate and a single-family home. Single-family home, as we discussed, is valued based on the neighborhood to some extent, and to a big extent. You could truly over-improve the home for the neighborhood. Commercial real estate is valued based on its cash flow, net operating income, which is income minus expenses is net operating income. You always value real estate as if it was all cash. Debt comes later. And debt is a big thing that boosts your return, but debt comes later. You always value it to be apples to apples, all cash. To just kind of finish this story for a second, if you took a McDonald's with a 20-year lease, and if McDonald's was paying you $100,000 a year, just to make it easy, in true net operating income rent. So at the end of the day, if you have no debt, you put $100,000 in your pocket from this McDonald's. And that McDonald's is in Boca Raton, and there's another McDonald's that pays $100,000 a year. Everything, same exact building, everything about it's the same, but it's in Riviera Beach. Or, I don't know, we'll go to an extreme. It's in Belle Glade.
These are not so nice, not so desirable neighborhoods. So desirable Boca Raton versus non-desirable, right? But 100,000 net.
Net operating income on all of them, McDonald's on all of them, and McDonald's has that real estate tied up for a very, very long time. So it is simply a McDonald's. They are worth, in theory, exactly the same amount of money. It doesn't matter if it was, if it's Beverly Hills or not Beverly Hills, right? If it's Boca Raton or not Boca Raton. Now, some people would argue and say, well, yeah, in 20 years, when if McDonald's leaves and I get the real estate back, the real estate is better real estate, so maybe I'll pay a little bit more. That's speculation, right? But commercial real estate, within reason, they're valued the same because all you're doing is you're buying a stream of cash flow for the next 20 years. Mm-hmm. And when you're investing in commercial real estate, and again, there's more to it, but it's a lot of people are there. I could buy this McDonald's, or I could buy a treasury bill, or I could put it in a CD, or I can invest it in. So it's as compared to what is really the analysis you go through.
Or said a different way, it's your return on cash, or cash on cash is also important too, because it's however much money you have to invest. You're looking at all these different asset classes and all these different options within those asset classes. What is going to bring you the highest rate of return on your cash?
It's as compared to what? Sure. There's no emotion, no school districts or view or the community centers down the road or look at the size of the backyard. Commercial real estate is an income producing, it's an investment.
With that being said, though, factored into your decisions, oftentimes I would assume, is if you know a certain geographic area is a growing area, maybe it's just outside of a metropolitan area, expanding in Tennessee or North Carolina or Georgia, one of these expanding states, as opposed to a state where population is leaving, you're probably going to be a little more likely to go for the one maybe in the area that has expansion, growth, as opposed to one that doesn't. That's one factor as well.
Sure.
So
that's
you
like
have your
level
numbers.
Two. That's like level two thinking.
Sure.
Right, that's level two. So we're talking about level one thinking.
True. But let's just go there just for a second.
Sure.
You're right. And that's actually part of where the value add part comes in, which I'll tell you how at Krause we do that, and then I'll tell you how even on my multifamily we do that. But in your scenario, if it was a well-performing McDonald's, and McDonald's you had a corporate lease with McDonald's, and they're on the lease for many times they're ground leases, which means you're leasing them the dirt, and they're building their own building. They don't sign 5-year leases. They want to know that they've got that site locked up for a very long time. You very rarely see a vacant McDonald's, right? It happens, but you very rarely see it. In that population is shrinking neighborhood, you can find a McDonald's that's performing well and is throwing off, good rent and good cash flow, and you could buy it at a cap rate that makes sense to you, you'd go there all day long because you have McDonald's. If there's 3 years left on the lease and the store is not doing so well, now you're starting to say, oh my God, what happens if they leave?
What's next?
What's next? Which is, that's where the value add comes in. In the Krause Company's world, we very rarely buy a McDonald's or a Chick-fil-A or whatever.
Triple net.
Single tenant, triple net. I was trying not to go too deep, but a triple net leased asset where the tenant pays rent and the tenant pays all the expenses.
Insurance, taxes, etc.
We create those. In other words, we do Chick-fil-A deals all the time, but we have the land and then we do the deal with Chick-fil-A and then either keep them or sell those. But where we do buy single tenant net lease assets is, and this has changed a little bit, but in the old days, and even still today, single tenant triple net lease assets were highly desirable purchases for doctors, dentists, lawyers, because you were investing in real estate, you were getting the benefits of the real estate, the tax breaks and all that, but you didn't have to do anything. The checks just came in, right? Mailbox money, so to speak. McDonald's, you're not worried about them. They had to fix their own roof. They had to plow the snow if you were up north, or whatever it was. But in our case with Krause, we do this a lot with 7-Elevens. So you have this 7-Eleven, maybe even more so, your dad bought the 7-Eleven, and now you're running it with the family. And now all of a sudden, lease is coming up. They have no more options. It's kind of an older store. You're getting a little nervous because you're not really in the real estate business. You're in the check cashing business of 7-Eleven.
Right.
And oh my God, what happens if they leave? I have to negotiate with them. I don't want a vacancy, right? You have these fears. And so someone like Krause Companies would say, we like the real estate. We know how to deal with 7-Eleven, McDonald's, whoever it is. I mean, pick your tenant, right? Exxon, whatever it is. We're not afraid of the vacancy, so we will come and buy your real estate from you. Now, we're not paying you what you would get if there was 30 years left on your lease, but we'll buy your real estate based on the risk that's there, and we'll take the risk. And you could take the money, which is a lot more than your dad paid for it back then, and you can redeploy it into other safer real estate. And that's where we come in and do the value add. And the value add would be, let me tell you something, if 7-Eleven signed a lease 30 years ago, between options and whatever, you could pretty much bet that rent is way below market unless the neighborhood got really bad. So you try to negotiate with them. I'm using 7-Eleven as an example, but you try to negotiate with them at a new market rent and get them to stay. Now, you, the landlord, might or might not need to throw some money at them to improve the site in order to get there. Or if they leave, you say, okay, what else can we put there? Maybe a Panera, maybe a Chipotle, maybe a bank. Maybe, you start to but that's what we add the value. So those are where the opportunities are, and those opportunities always exist. To get back to the lesson I was trying to teach, though, was I had this 40-unit apartment, much larger than I ever wanted. So I actually brought it to Krause because I said, look, guys, they had a 1031 exchange, whole nother discussion, but it's a tax-free exchange. It's a way to shelter your gains forever if you do it right. Mm-hmm. Never pay tax on your gains.
Sell a property, instead of paying taxes on your gains, you use the 1031, buy the next property. There's certain time frames that are necessary.
Right. So you're taking all the money and you're putting it into the next property.
Yeah.
And so some people say, well, then where do I get money? But you can actually finance that money back out later. But as long as you don't take the money from the sale and put it in your pocket, you don't pay tax.
Yeah.
So
they had a 1031.
They had a 1031 exchange, and I said, guys, what about this? And we don't do multifamily. And I said, okay. And then a couple of weeks later, we still hadn't found our exchange. I said, guys, what about this? We don't do multifamily. There's one of three things wrong with this scenario right now, the asset. Either Jay is doing something wrong, the broker did something wrong, or this is a diamond in the rough. I discovered, they just don't know what they're selling. It turned out actually that not on purpose, but the broker did do something wrong. It wasn't so actually I tied it up, and I learned during my diligence that the broker made a mistake. But again, the broker was phenomenal. It was not unethical. He actually went to his assistant and said, hey, take this purchase price, calculate the taxes, and put it in the analysis. She didn't there were some other assessments that were outside of the formula that she didn't put into the equation. So the the net operating income was overstated by some. We don't need to go down that road. We fixed it, and but I wound up.
You still found value in the deal.
I wound up finding a way to buy it. It was the scariest thing I've ever done because I had to buy it myself. I actually
not to go too deep, but how did you do it? Did you get other investors to come in with you? Or
no.
Okay.
So
just found money from certain places.
For starters, and the interesting thing is why it's always good to talk to people and not keep everything to yourself is I was actually having a beer one day with a buddy of mine who sells shopping centers for a business, for a living. He's very successful. I'm sitting there telling him this story about this 40 unit and that Krause doesn't want to do it and I really think it's a great, and before I could even finish telling him about it, he says, I'm in. I said, well, I'm not asking you for money, but I haven't even told you the story yet. Why are you in? And he said, and I still remind him of this all the time because he said, I'm in because if you think it's a good deal, I know you, and if you're willing to put your money on it, I'm in. And I said, well, okay, thanks. I said, again, I'm not asking you for money, but I appreciate that. And I went home that night, and I was like, son of a gun, if he believes in you, why don't you believe in you? And I always did, and I'm a very positive person, but still you get scared, right?
Yeah.
The first
well,
deal.
you've been burned once in the stock market, so that sticks with you.
And so I said, I just got to do this. I would, back, this is 2011, you were able to, you could still buy, first of all, property was a lot more affordable because 2011, there was a real estate correction nationally. You could buy commercial real estate with 15%, 20% down. You could get pretty good financing. You actually could even find stuff with 10% down. You can get pretty good financing.
I miss those days.
Yeah, I know, right? So I did it. And the reason I tell you this whole long story for a minute is I'm so glad I did it because the amount of work. Now remember, I still had I still work for Krause. Sure. I mean, this is not something, and I still to this day give them 110%. I'm part of them, so I give us 110%. But fortunately there was a husband and wife that I still love to this day and work with. I actually brought them to Florida, who came with the property, and they really helped me run it. But the lesson I learned there was it takes as much time, it takes as much energy, and you have as many problems on a 40-unit deal than you do on a 4-unit deal. A roof is a roof. A lawn is a lawn. And if you have let's say you have just to put it in simple terms, you have a 5-unit building that's 5,000 square feet. Each unit's 1,000 square feet. It's got a 5,000 square foot roof, right? If it's a single floor. If you have a 10-unit building on 5,000 square feet, 5 below, 5 above, it's got a 5,000 square foot roof. So now you have 10 units that can pay for a 5,000 square foot roof. If you have a 5-unit building, and it has a lawn, the landscaper is going to charge you, I don't know, $150 a month to take care of the lawn, or whatever it is, right? If it's a 10-unit building, he might still be charging $150 a month, but if he's charging you more, it might be $200 a month. It's not $300 a month, which would be double what the 5-unit building was. So the economies of scale in money and in time work in larger units. And I actually...
Property management, too.
That's what I was just going to say.
Your management fees.
The other piece, too, besides management fees, it's just like when you're doing that much business, you have guys that are like working for you all the time. Like in my 90-unit portfolio, it's like I have guys that are just going from one building to the next. They pretty much work for me 40 to 70 hours a week.
Right.
So it just becomes like, oh, we know the right guy to call because we got him doing this. Just pull him off that, do that. Instead of like you have this like single family home as an example, and you're like, who do I call to do this? I've never called anybody to do this work before, but I'm like, I did this 7 times, in the past month. Right. Just have them go do the same process.
And when you have larger, especially when it's concentrated, now you can afford to pay a team or somebody else to do that. Like I said, I could never have achieved what I achieved and also done everything that I do with Krause if I had to get the phone call because the toilet backed up. If I had to get the phone call because the air conditioning was out, would never be able to do it. From day one, never, and there's another lesson going to come here in a second, but from day one, I have never received any of those phone calls. And not only that, here's the lesson. you don't get paid for ego or for your perceived success. Your perceived success, what you've done is here and is here. Your family, you know what you've done. Your family hopefully knows what you've done. That should be good enough. Nobody else necessarily needs to know what you've done. So whether I'm at a Krause property or at one of my properties, I am never the owner. I work for the ownership, which is true.
Yeah.
I work for the ownership, but I'm never the owner. I'm just another person in the system, and that allows you to not get those phone calls in the middle of the night. This is our facilities guy. He handles the maintenance and the operations stuff. You have a problem with the toilet? Call him.
Said a different way, I'm sure you spend more time at the properties when you're first buying them and you're getting them stabilized and you're increasing rents, fixing them up. And so tenants get to know you as Jay. Hey, Jay. But you're putting yourself out there not as Jay, I'm the owner, because you don't want to have the tenants calling you at all hours and desperately pleading with you not to raise the rents or whatever it is. You're Jay, who's just a member of the team, right? That's said a different way.
Sure, I'm on the management side, but I still, it's very important, even like with Krause. And with Krause, it's true. I mean, I'm not, there's a level of trust on the Krause side that they know I'm never going to willingly or knowingly do something wrong for the family.
Sure.
But still, so I could go and sit with a tenant, and if we have a problem, I have the ability to solve the problem. But there are still partners, and there are still lenders, and so there's nothing wrong with. I mean, and
you're not lying. What you're saying is you're telling the truth.
Yeah, I have a lender.
You're not the big boss.
Yeah, I have a lender. Sure. I have to. You know what? My lender wouldn't. I got to go and see if I can take care of this with the lender. I have to talk to the partners. Right. It does a couple of things. It gives you a moment to leave and think. Yeah. It doesn't allow them to back you into a corner. And you know what? I don't think ill of anybody, but I think a lesson, and the lesson that I try to teach people all the time is, you don't need to, brag or boast about what you are or what you have to others. I'm the owner, and more times than not, that hurts you more than it helps you. And so being a little bit humble and also putting you on a level where you are kind of like them, you have other people you need to answer to, does help a lot. But to the point, though, back in this equation of the 40 unit, and then as I grew, is size allows you the scalability to have other people who can do the day-to-day so you don't have to. So you can be the best real estate lawyer that you can be. You can still go and run a successful brokerage practice because you're not getting a phone call about the air conditioning or the toilet or and that's what scares a lot of people. And you know what? If you have scalability, if you have size and you have scale, you can afford to pay someone else to do that and still do very well in commercial real estate.
For sure. And we'll get into, I have a question about the team that you built and your team around you, because I think teams are so important. Real estate, as they say, is not an individual sport, it's a team sport. Mm-hmm. Even if you're a single owner of a multitude of properties, you need a team around you. You need your handyman, you need your property manager, you need everything that goes with it. Your plumber, your attorney. Yeah, there you go. But before we get there, I should have asked you this up front, but just so the viewers know that you're definitely a legit guy. With Krause, you all invested in, you don't have to give exact numbers, but this is well over $1 billion worth of assets, right? Would you say?
Oh, over my career, yeah. well over. Yeah.
Yeah. And then on the multifamily side, you've built up the portfolio, whether individually owned properties that you have or with your other partners at Krause or whoever it is, over 400 units, right?
Yeah, well, so the great part of that story is when I moved to Florida.
I'm fast forwarding just a little bit.
That's okay, yeah. When I moved to Florida, at the time, I started poking around out here. I was out here visiting. My wife and I were here, and we were visiting, and I said, if we're going to come here, let me see if I can find see if there's real estate. I actually tied up a property in Riviera Beach. That's what you were referring to before.
And before we get there, at the time you moved to Florida, which is how many years ago?
So I actually bought my house here in late 2018.
So I moved here 5 years, more or less, 4 to 5 years. You had 40 units, so you had the 40
No,
unit building there?
I had more than that.
How many did you build
I
up in
had
California?
in San Diego County, and that's another lesson. The 40 units was in a place called Spring Valley in San Diego. If you're going to build scale to be able to build a team, the biggest mistake I could make was buy 20 units 60 miles away from those 40 units, right?
You got to build a whole new
or
team.
even 30 miles away from those 40 units.
Yeah.
You want to make it so that your team that you put together can easily hit all of them. So that 40 units became my bullseye. And anything else I was going to buy had to be
a radius. Yeah.
And I didn't necessarily use miles as much as maybe minutes. My facilities team, my maintenance person, my property manager needed to be able to get from property A to property B in 20, 25 minutes, not much more than that. Otherwise he or she are just on the road all day, and that's terrible too. So I had about a little over 100 units in San Diego County, which is San Diego is
it's a nice
big
area.
feat. Yeah. And I sold over the last couple of years, sold all of them and moved that money to Florida. But fortunately, and actually surprisingly, and in a lot of ways, it's made it fun. My first deal that I was telling you about in Riviera Beach, Kraus actually said, they had a 1031 exchange, and they were being much more open-minded to other types of commercial real estate, and again, real estate is real estate to some extent. And so Kraus got into the Riviera Beach deal with me, which actually turned out to be a really good blessing in disguise, because my assimilation into real estate in Florida was not as easy or smooth as I thought it would be. It wasn't the same as it was in San Diego. There's, first of all, different rules. There's, to some extent, some different work ethic in certain people.
Sure.
And overall, there were just some challenges that I wasn't expecting.
You bought in a tough area. Let's say Riviera Beach is going to be very, very different class of property from probably where you're at in San Diego.
Oh, absolutely. Yeah. I mean, I've always been in 90% of what I own is still what I call workforce housing. My focus, and where I think that the greatest value to be added is in affordable housing or workforce housing.
Agreed.
Housing for the bus driver, the waste management truck driver, the person who works in the kitchen in a restaurant. Those people are hardworking and they need a place to live. I mean, it's not all about rooftop swimming pools and resort style gyms. Those are great properties to own, but at the same time, they're kind of not. I mean, my joke is, and I'll pick on my family for a minute because then I don't offend anyone. But my joke is that the worst tenant I could have is my wife or my daughter, right? Because I mean, it's the worst. Because if the cabinet is worn a little bit, if the carpeting is starting to wear out, if whatever it is, you bet they're calling the landlord and saying, I'm paying, my tenant, and again, I try really hard to create a good place for them. I really do. I'm not just, I mean, it's hard. It's harder, and it takes time. I mean, there are properties that I own right now that aren't there yet because we're still in that value add stage. But at the end of the day, if I could provide a place where the roof doesn't leak, where the air conditioning is cold, where the water is hot, where the atmosphere is clean, right? There's not trash everywhere. Where the tenants are treated with respect, that's all they want. And so we try really hard to do that. And usually those are where the true, for people who want to get into the business, that's where the true money-making opportunity is. And because that's where you're going to find assets that still, let's say, have some distress to them, and that you could buy at prices per square foot that are still today below replacement cost. The building that was built in 2019, you're not, unless there's another story back there, you're not buying it, at a bargain price. And you're not buying it at significantly below replacement cost, if below replacement cost at all. And you're competing with bigger money and institutions, which is a whole other part of my thing. Is I try to play in the space. This is my own stuff. With Krause, it's a whole different story. But we kind of do the same thing. We don't usually compete on the Krause side. We try not to buy buildings that, Blackstone and AIG and all these institutions are buying with other people's money, because they're getting fees and they're going to get management fees and leasing fees and acquisition fees and syndication fees or whatever it is.
You can't compete with them.
Because you can't compete with them because the return is less important to them. As long as they're providing a return to the investors that appears to be better than what you can get at the bank, which is becoming harder to do today. But it's all they care about. Then it's fees, fees, fees. We buy Krause, and then also on my own, we buy because it's our money and we buy to own it. And we buy, even though the plan might be maybe we're going to sell it again in 3 to 5 years, you buy it as if you're going to own it forever. And you run it as if you're going to own it forever. And that's always treated us right. So if, by way of example, you got to put a new roof on, and you could put a 10-year roof or you could put a 20-year roof. And the 20-year roof is not that much more. You put the 20-year roof on because even though you might sell it in 5 years, you might not. And then you've done it right. You don't fix with bubble gum if you can help it. And so we try to not compete with the institutions, and we try to not compete with the, again, just to put this in a category, the doctors, the dentists, the lawyers who are trying to buy the smaller stuff, and they think they want to get into real estate.
The 6 units.
So we go into that space in the middle, and there's plenty of people there. At Krause especially, and then even on my own stuff. That's when you build relationships. You meet with the seller or the broker who represents the seller. You show them that you're real. You speak honestly with them. You let them realize you are the right buyer, because the biggest mistake that a broker can make on an investment sale is choosing the wrong buyer. Yes. The buyer that maybe offered $50,000 more than the other guy. They tie it up. They drag you out. Yep. They try to retrade you, and at the end of the day, even if they do retrade you, then they don't close. And now
90-day close, 30-day inspection, 60-day financing contingency. They drag it out till day 59, and then you get a letter from the lender that is probably a fake letter saying they don't qualify, and I want my money back. Right. That's cost your seller 60 days.
But then you might have lost your other buyer. Because if we had a 1031 exchange, we can't wait.
At that point, you got to move on.
And that's why reputation matters in this business. It's a small world. Guys continue to remember who you are, right? So,
Well, and that goes back to the Amos Krause philosophy, which is a Krause company philosophy still to this day. We are truly about relationships. We do, at the holidays, we'll do a lot of, at Krause, we'll do a lot of holiday parties, banker lunches. We send out pairs, Royal Riviera pairs, to people that we haven't done business with in 10 years. But we did business with them, and they're still in the world, in our arena. And sometimes, amazingly, in the Krause philosophy, there are people who have retired from the business, and we will never do business with them again. And they still get pairs because it's about integrity and relationships. And so when we do that, and people know that, and tenants know that. I mean, I've had brokers tell their tenant or tell their seller, if these guys say they're going to do it, they're going to do it. So they may be $100,000 or $200,000 when you're dealing with bigger numbers. They may be $500,000 less. But if they say they're going to do it, they're going to do it. And we can show you why we're $500,000 less. And if the other guy isn't,
something's wrong.
Well, either they missed it, or they're going to come back and ask you for it later anyway, and then even so, they may not close. So in integrity and networking, which is honestly, I'm glad to see that people are starting to get out in the world again, I think is the biggest crime for anybody young getting into our business or any business, is not being able to go to networking events and press the flesh type of things and just be with people. On the Krause side, there's a conference called the International Council of Shopping Centers, ICSC. They actually renamed it and they took the word shopping centers out of the name, which I think is a huge mistake because they're trying to go with the times that maybe shopping centers aren't as relevant as they were. That's a whole nother discussion. I agree that regional malls will go through a change, but I think it's still quite a way before we totally give up on retail, brick and mortar. As a matter of fact, going to another story, but there were these things that opened up especially during COVID. But you see, there were a lot of food trucks, right? And then there were a lot of what they called ghost kitchens. Yeah. And a ghost kitchen, you could have a kitchen in let's forget your house for a minute because that's technically not legal, but you have a commercial kitchen in a building somewhere that could be anywhere. It could be in an industrial building. And you would prepare the foods and deliver through Uber Eats or DoorDash or Delivery Dudes or whoever your delivery company is, and people created a great business that way. What's interesting about that, and originally, I looked at this and as a landlord, as much as I love a good food truck, or as much as I love a good down in San Diego after going out at the bars, I love to get the burrito from the guy out on the corner who's got the burritos in the cooler, and those are great burritos, but it's not fair to the guy who's paying rent, paying taxes, paying insurance, paying for the utilities in the taco store right there. Yeah. And so I always was like, this is just it's really not right. I mean, that food truck could just pull up but what's interesting about it is as you see retail vacancy occur, if it's a restaurant space as an example, many times you will see a guy who's got a food truck who wants to lease that space. So that person actually, even though he's successful or she's successful in a food truck, really has a dream of opening a brick and mortar store. It's interesting.
It is.
I don't see that retail is going to be a challenge, and it's changing. But I don't think it goes away. There's still there's interaction. There's still that experience. Right. It's changing. Yes, when we were kids, going to the mall was what you did. It was the event. Matter of fact, we probably drove our bikes to the mall. These days, God forbid your kid should take your bike off the street and it's an Amber Alert. I mean, it's but nobody, they don't go and hang. The mall is the chore now, right? No one spends the whole day at the mall. So malls are changing. But to me, and again, maybe I'm still old school, I still like to go to Publix or Whole Foods and pick my apple and pick my banana and look at the spinach that I'm buying.
I do too. Maybe I'm old school too. But
and so
I can order some things on Amazon, the necessities, the almond milk or this or that, or whatever.
Right. And I do sometimes. But the other thing is, it's somewhat part of my wife and my kids and I. We will actually going to Costco is a thing that we do. Sure. It's fun, and you know what happens? Unfortunately, you buy 17 things you didn't think you were going to buy, but that's part of the fun too, and that's why I think retail will change, but it won't go away.
So on that note, with your experience, you wear two hats. You wear the Kraus hat of being on the Kraus team, that you invest with them and what they want to invest in together communally. You make decisions on that, and then you have your own portfolio that obviously you're investing in multifamily, but
and now with Kraus.
Yeah. And now with Kraus too, right. So you're cross kind of pollinating in that multifamily industry. Is it your gut, having been in commercial for so long, now in multifamily for the last few years, that you want to continue moving in the multifamily direction full speed ahead? Or will you also on a personal level start looking at commercial deals?
Yeah, what's your preferred asset class? Well, follow up to that. Yeah,
that's a better way to say it.
It's a great question. So let me and the answer for me, and then for everybody else, is it kind of depends on where you are in your life. The multifamily, again, part of it is if you have a good team, but still requires more attention. But the benefit of the multifamily, here's the benefit, which also can be a negative. If you do, just to use that McDonald's again as an example, if their rent is $100,000 for 5 years, and then it goes up to maybe 120 for 5 years, and so on. That rent is set in stone. If that McDonald's is paying $100,000, and 5 years from now they're paying 120, but you could have gotten Chick-fil-A into that same space to pay you $300,000. Too bad.
That's the downside.
You got McDonald's, $120,000. It is what it is. On the flip side is if all of a sudden there are 3 vacant pads on the street and McDonald's could move over there for $80,000, too bad. Now, it doesn't mean that they're not going to try to come to you and renegotiate the next option or something. But if you know it's a good store, you kind of got them. So when you do long-term single-tenant net lease assets, or even shorter-term, you have a nail salon in a shopping center. They sign a 5-year lease with options. And the options, by the way, are only good for the tenant. They're never good for the landlord. So an option, people go, well, I'll give you a 5-year option. Just understand that only the tenant has the right to exercise that option. It's the landlord is stuck. So you don't necessarily want options. But let's use a nail salon instead of McDonald's. That nail salon, the rent is the rent for the next 5 years. Whether the market goes up or the market goes down, if they want to stay in business there, and they're going to pay you that rent. In multifamily, you have the ability to reset your rent annually. Or if a tenant chooses to stay month to month, technically you could reset the rent monthly. Now, that's not being a good landlord if you change your rent every month. That's a different story. And so you still should be a good landlord.
But still, even annually, yeah.
Annually, absolutely. So you have the ability.
And we've seen, especially South Florida here, but I think across the country to an extent, have seen significant rent increases the last 3 years due to inflation and everything else that's happened, and a lack of supply. So we benefited from that upside the last few years, because each year you're able to increase the rent. Yeah.
Which allows you to also buy distressed assets and add value. And don't let me forget to do the quick formula to show somebody why commercial real estate is just so much more exciting than, let's just say, single family for a minute. But to answer your question on if you have a shopping center, right, you're stuck. The market could go down, you got it, good for you. The market could go up, you're stuck at the rents that are there. So you don't have the ability to add value as quickly. Now, in a shopping center, if the lease is done correctly, as costs go up, you get to pass those costs through to the tenants, what's known as a triple net lease. And again, not to get too far off topic, but you do have some shelter in the retail. In multifamily, you have to recapture your expenses in the rent. And so that's actually been a problem in Florida right now.
Sure.
Insurance has gone up so much, and we cannot raise the rents enough to make us where we were last year, which is why the tenants, you're raising the rents on tenants and they're yelling at you, and they don't understand. You're not even coming close to covering this insurance bill I just got.
Right.
So multifamily has a lot more flexibility and a lot more of the ability to truly be a hedge against inflation. As costs go up, you can raise your rents. Yeah. Retail or commercial has the ability to have less headaches and less challenges, because you sign a lease, Kelley Grant law firm signs a lease for 5 years. I pretty much don't have to worry about that space for the next 5 years. Mm-hmm. However, when Kelley Grant law firm leaves, it might take me
the vacancy rate the vacancy length.
Right.
Yeah.
It could take me 6 months or longer to find a tenant. It could take me 3 months or longer after I find the tenant to get the tenant to start paying rent. You have to do improvements, which many times come from the landlord's pocket.
Build out, so tenants say, "Hey, I want a wall built here. I want a front desk built here," and
I mean,
incentivize them.
The joke I tell usually when I try to compare that is, I have Chipotle, and they want to come into one of my spaces, and they walk into the space and they say, "Yeah, this is a great space. This could work for us. We like the neighborhood, but in Chipotle, the bathrooms are always in the back left corner, so you need to move the bathrooms. And in Chipotle, we always like to, I'm making this up, but you get the idea. Yeah. And in Chipotle, we always like to have the back door line up with the front door, so you need to move the back door. And you know what I'm doing while I'm having this meeting? I'm taking notes. You know why I'm taking notes? Because I'm going to go get a price to figure out how to move the bathrooms, how to move the door. You know, the hood needs to be over here. How am I fixing the fire sprinklers? I am actually, as the landlord, figuring out what it's going to cost me to do the Chipotle deal. Sure. Now, come over to my apartment building. You move out. Larry shows up. He goes, I love this unit. But could you take the bathroom and move it over here? Like, what are you kidding? You know, see you later, right? So you don't have to do that. And if Larry doesn't take the unit, somebody else will. There's only two factors in why your unit stays vacant. Only two, right? Your rent is too high, or it's a piece of garbage, and you need the condition, right? The condition of the unit or the property. Both of those things are things you could fix. You could lower your rent, right? Or you can fix your property. And that's somewhat true in commercial, but some location plays a big part of commercial. And in multifamily, it doesn't. If you want to be in Boca Raton or in Delray Beach, you don't necessarily care if you're on this street or this street, as long as it's a unit that suits your needs, both economically and amenity-wise. If you are Starbucks, there's a big difference between being on the going to work side of the street before I-95 and being 2 blocks off of the street that has an exit on I-95. You need to be on a street that has an exit or an entrance onto the interstate or the freeway, because in the days before COVID, as you're driving to work, you stop and get a coffee, you know, and there's actually a science to that. I mean, you will see, you probably never paid attention to this, but your coffee shops are usually on the right-hand side of the road going towards the freeway, and your KFC, or this isn't always true because it's still shopping center related as well, but your KFC or your Wendy's or your, you know, whatever it is usually on the right-hand side of the freeway, right-hand side of the road, coming from the freeway, going home, right? Not always true, but more true than not. Sure. In multifamily, not so much. So you have a wider net that you could cast in multifamily. It's an easier thing to run, and it's less expensive to run when you make mistakes are easier to fix.
And I would say there's one added thing we saw, which probably is not something we'll hopefully ever see again in our lifetime, but multifamily is not so susceptible to market shocks. I mean, look at what happened with COVID. You know, obviously we know the office market is collapsing because of people now working from home, and all of that started with COVID, or certainly escalated it. Maybe it started a little prior to COVID, but you know, with multifamily, people need a roof over their head.
Especially in the supply situation we're in with all the assets
limited supply. Yeah. Stable or increasing demand. You know, again, what I say, I look at large demographic factors too, changes. Not getting political here, but we have millions of people coming across the border every year. We have our legal immigration, and then we have millions of those coming across the border illegally. They need a place to live. They're not going to be deported. It's just not going to happen. I think we all know that. So we need housing for these folks in all of these, especially in these growth states. Most of these folks are not going up to North Dakota to work, and many of them are not going up to Massachusetts. They're coming to Arizona, Texas, Florida, you know, the growth states. So that's a big demographic factor that I look at for multifamily.
Very true. And look, again, not getting political at all, but we still are a capitalist society that's based on business doing what you know. Businesses will always find a way. Successful businesses will always find a way to provide a service that people need and then make money doing it. Housing, no matter what quality level of housing you provide, will always be in demand until. And one day this will happen, but maybe. But the lag time of it is long, so therefore you'll be able to see it coming, unless and until there are major incentives for people. Major, I mean, not like you said. Well, there are incentives now, but they're window dressing incentives right now to get people to build lots and lots and lots of housing, to accommodate affordable
housing.
Housing.
Yes.
there will always be a supply-demand imbalance, and so you will always be able to, if you provide a clean, safe, well, safe is a hard thing. I hate to say the word safe because I have no control over the fact that maybe your neighbor does something stupid or whatever.
Yeah, right.
But a clean place where the air is cold, the water is hot, and the roof doesn't leak, you'll always be, and you're a good landlord. You'll always be able to find a tenant. You'll always be able to weather the storm. It's truly, a supply-demand imbalance.
Yeah. Even the affordable housing that's being built isn't necessarily super affordable.
That's right.
That's one thing.
That's the problem.
Then on top of that, going back to just illegal immigration, right? It's most of those buildings won't take those types of people either because they need certain background checks done. So because most of those buildings that are being built are more institutional level stuff, right? And so they have certain requirements that you need to meet. So they end up funneling down to assets like we own. Yeah.
Right.
Yeah.
I love this asset class. As a matter of fact, going back to my wife and my daughter for a minute, who are the worst tenants you could ever have, right? Not only,
I hope they don't watch this. Jay.
Not only are they the worst tenants you could ever have, but let's use my daughter as an example. Not only is she the worst tenant you could have because she expects a level or a quality because of the way that she grew up or whatever it is.
Class A plus housing, yes.
But I can assure you that when my daughter, so she now lives here, but when she rented her Class A apartment, that, by the way, I give both of my kids 1,000% credit for what they've done in their life. I'm very, very proud of them. I have never paid their rent. They pay their rent. And so if my daughter lives in a Class A high-rise, which she was in Philadelphia with a gym and amenities or whatever,
she's earned the right to complain.
Exactly.
She's paying her rent.
It's her.
Yep.
But I can assure you, when she signed that lease, and she's living there with her now. She was living there with her now fiance, and like I said, they're both here now. But when they signed that lease, I can assure you, they didn't move into that apartment and say, "We'll be able to raise our family and retire here." Mm-hmm. It was, "This will be good until we can find a place of our own," right? And so, in the Class A tenant world, as long as to an extent, it's much more transient. Those tenants, those people have the ability and the wherewithal to move to the brand new building that just opened down the road if they want to, or eventually buy a house. Again, I don't condone what I'm about to say, but this is just the way that it is right now. And so that's why I say if I provide a good product, at least it works. Many of my tenants don't ever move in and say, "This will be good until we can buy our house." Some might, but most don't. And so they're there as long as you provide a roof that doesn't leak, water that's hot, an air conditioner that's cold, you pick up the trash, you provide them a place that they can call home, they're going to stay with you for a very long time because moving costs money too. And
yeah, I agree. And that kind of goes to background checks. Like, I don't know about you guys, but with background checks, I really just look for the no serious criminal records, felonies and violent things like that, and no evictions. Of course, no bankruptcy too, but I don't even really look at the credit score. I just glance at it. I'd say the great majority of the time, my tenants don't have a credit score over maybe 620. I'd say 80% of the time in the units that I rent, and I'm okay with that.
Same.
If they're not paying their credit card, that's not really my problem, as long as they're going to pay their rent, as long as I know I've got first, last, and security, and they don't have evictions. Because what no eviction shows me is, maybe they are bad with their credit cards and they've been swiping too many of them, not paying them, so their credit score is low. But at least they know they need to keep a roof over their head. That's the minimum that I look for.
I do the same. Sometimes I very, very, very rarely have turned someone down based on credit, unless, as you said, there's a market history of like multiple evictions or that type of stuff.
Course, yeah.
But if I do look at things, I will look at, again, understanding the challenges sometimes financially that some of our tenants have.
Of course.
If somebody has a low credit score because they owe a hospital or a doctor a bunch of money,
wow,
I discount that entirely.
Oh, yeah.
Because that's just, you know what?
Life in America.
Right, I get it.
That's
Sure.
life in America.
If somebody has collection accounts from 3 different car dealerships and 4 different cell phone companies, I'm starting to think, okay, here's someone who's not even paying the bills for their basic necessities,
True.
that might be a problem. It's
true.
You know, and so you look. I would look at it that way. I don't look at the credit score.
You look at
I
the credit lines.
I look at the habits.
Yeah, the habits,
right.
yeah.
If you're paying your electric bill, you're paying your cell phone bill, you're paying for your car. You understand that you have bills you need to pay. If you you know,
or have your
had to
car
go-
repossessed. That's
yeah,
not
right.
good.
But if you
Right.
had to go to the doctor for something and you can't afford to, that's just I can't fault you for that. If anything, again, not to get political, but you got to fault our system maybe for that. Maybe. So I don't look at that, but I do. You know, I do feel that there's a great niche in that in helping people find good housing and that
good
affordability
housing.
level.
Yeah.
Go ahead, I'm going to ask Larry, because I want to talk to you about the value add and how that works in those two.
Yeah, well, that's what I was generally going to comment on, like, especially if you're providing like a good, as you mentioned, just like good space, good space to live in. It's of huge value add especially in this market, because a lot of older landlords who have owned stuff for, I don't know, maybe even built them, right? And some of them were buying off of these guys who built them in the 70s, right? They just kind of just let it go. Yeah.
They let it go many times. That landlord either has a memory that's old, the market's not the same anymore, but they're afraid of or don't want to deal with a vacancy, and so the logic is, the market's 1,500. This guy's paying me 1,100, but I don't want to deal with it. I don't want the vacancy. I don't want the.
Well, it's also that my mortgage is 25 years old
Right.
on a 30-year mortgage. I only have 20% of my original balance left to pay. I'm at a low interest rate. What do I care?
Well, okay.
Their payments are so low.
That's the way they think.
Right, exactly.
Okay,
I'm getting cash flow. My mortgage is paid. I'm going to leave the rent low.
But let me.
And I'm going to give low service too.
Maybe.
Yeah.
But let me. It's a bad analogy, but it's an analogy nonetheless. Let me. That philosophy that you just said of the landlord who goes, well, my mortgage payments are low. That's like you going to whatever your local restaurant is, and the bill is $50, and you're going to throw a 20% tip, so now it's $60, and all you have is $100. And you leave the 100, and you're like, well, I have more hundreds in my pocket, and I don't need to wait for the change.
Yeah.
It's a bad analogy, but you're leaving money on the table, right?
Course,
and that. So for the people who are looking for an opportunity, there's your opportunity. Is the person who is thinking like you just said, because they don't want to deal with the challenges of a vacancy, they don't want to deal with the expense, and this is truly where the opportunity is. And it's actually a great segue for me to just show you the to me the aha moment, and I'm going to stick with commercial real estate, industrial buildings, office buildings, retail. The theory is exactly the same, but I'm going to talk about, for this example, a multifamily building versus, let's just say, a single family home for a minute. First of all, I on the single family homes, I love all of these flip this house shows that you see. There's one in particular that I laugh all the time. And my wife, if we're watching together, she goes, okay, here he goes. He's about to have a rant. Because, the guy will come in. This is the guy in Vegas, the guy and he's driving his Ferrari and whatever. And he comes up and he's flipping this house. And they come in and, he walks in and the contractor might say, which before I go there, you always have to plan for the oops or the what if, for the unknown. Yeah. You can't put your pro forma together and have it exact to where at the end of the day you're going to make $30,000, because you could find a $20,000 mistake, right? So the guy in Vegas, he comes in and he's the contractor says, well, we have a problem. Well, what's the problem? Well, you see, when we opened this up, there's this. I'm going to an extreme on this one, but there's this cross beam that's kind of supporting the house, and it's got termites and it's got this and it needs to go. Oh, okay. Well, what do we have to do? Is I got to jack up bring in some thing, got to jack up the house. We're going to cut it out. We're going to put a new piece of timber in there. And, goes, oh, geez, what's that going to cost us? And he's like, $3,500. And like, so I can't get somebody to come up and replace a sink for $3,500. And this guy on these shows, is
right.
And
he melts down.
Right? Yeah. $3,500.
I know. Yeah. Right. Here's the camera meltdown. Storms out of the house.
Right.
Jumps in his Lamborghini.
Yeah. Exactly.
Flies away.
We got to, or how much is it going to cost us to replace all these cabinets? $1,600. I turned to my wife. I said, "Our sink costs more than $1,600. I mean, come on."
Yeah.
So
the expectations my customers have when they're like walking through a house when I'm brokering a deal, it's like, no,
they watch HGTV.
Yeah, right.
Like,
and they think
that's expensive.
Right.
Yeah.
And so first of all, that's not real. Secondly, so when you have these blank moments, right? They always cost more than what you see on TV, and you have to be able to afford to carry it. Otherwise, if your deal is that thin, it just lost. Because remember, on the single family home, you can only get that home. You might make it the most valuable home on the street, or the most valuable home in the submarket, the tract. But that might mean all the other homes are selling for $500, and yours might sell for $525.
You're not getting $1.5 million when the average sale price is $500.
No matter what you do to it.
Right.
No matter what you do to it. And interestingly, on the flip side of that, from another side note, I tell people when on the broker side, when they try to show me the comps of what if I'm going to sell for a minute, and I kind of say, if everybody always bought based on the comps, then homes would still be priced like they were in 1962 because those were the comps, right? There's always a little bit above the comps. So you can bring things, market up, but still within reason.
Within reason.
So if you go and you buy a house for $400,000 and you put $100,000 into it, you might be able to sell it, let's just say, for $600,000. You have $500,000 in, you sell it for $600,000. By no means is that a bad thing. You made $100,000. Remember, it's a job. By the way, the IRS does not consider you in the real estate business if you flip houses.
Yeah, that's income.
That is income. That is inventory. That house is no different than you buying a car, cleaning it up, fixing it up, getting rid of the dents, putting new tires on it, and selling the car. That house is inventory. That is what you are selling. You're not in the real estate business. You don't get the tax treatments of real estate, which is, even if you're paying taxes, first of all, you can't do a 1031 exchange, I don't think, when you're flipping a house.
No.
I don't, okay. Yeah. You definitely don't get the capital gains tax treatment of that when you're in the business of, you might get away with it once, but if you do this over and over and over again, now you're in the business of flipping homes, the IRS says, that's inventory. And you made $100,000. That's great. Now, if you decide, I'm going to take a month off and just go hang out in Hawaii, you're making nothing because you're out of the business, right? You're done.
What I like to say is you got to keep doing it, right? So you got to keep performing this magic trick. You got to keep iterating, improving, getting more creative. It's a job that requires you to figure out the next step. When you buy an asset and you hold it, you kind of can just, like, okay, that's that.
So let's talk about the same value add. Let's just say that you buy this apartment building from that guy who is just, now he's done. He never really wanted to. And there's lots of these out there. I'm not making this up. He's owned the building for 30 years. He hasn't really done much to it. The units are tired. But the rents are, I'm going to use examples of real life from me. The rents are $1,100. On the market, if it was a nice new unit in the same quality of building, but the building was painted or whatever, let's just say, might be, let's just say $1,500, $400 gap, which sounds like, well, okay. And you go in and you go into the unit, you gut the unit. You put in new cabinets, new kitchens, new toilets, you paint it, you scrape the popcorn off the ceiling and whatever, you make it a nice new unit. It's still the quality to the demographic you're targeting, but it's new and it's clean. I used to be able to say you could do that for about, because you're doing multiple, for about $10,000 a unit. Now it's probably more like $15,000 or so a unit. Because you're still going, you're not, in this world, you're going to Home Depot and you're buying a refrigerator for $400. You're not buying a Sub-Zero. You're buying cabinets from Home Depot. You're buying, you're doing it, you're still doing it right.
Yep.
So $15,000. Let's just, remember, this is a 10 unit, but let's just work on the one unit for a minute. You paid $15,000. and you raise the rent, the new tenant comes in, old tenant's gone, new tenant comes in, you're charging them $1,500, $400 a month more than the old tenant was paying. You paid $15,000 to get them. That $400 goes straight to the bottom line because all your expenses are already covered out of the $1,100, right? So 400 times 12 is $4,800, right? Now, some people, I don't agree with this, but some people would say, wow, that's almost 30%, 33%, so it's a 30% return on your investment. That's amazing. Yes, it is, which means basically in 3 years of that increased rent pays for all those improvements after 3 years, and in year 4, it's all cash flow. That's true, but I don't agree with that. I don't look at it that way when you're in the value add world. You raise the rent by $4,800, right, in that unit, without having to go into, I kind of explained what a cap rate was before. If you apply a 5 cap to it, which is harder to do today, so I'm going to go both ways. If you apply a 5 cap to it, that $4,800 created $96,000 worth of value on the property. You increase the value of that real estate by $96,000 at a 5 cap by spending $15,000. At a 10 cap, which is also not possible today, 10 cap is too high, 5 cap maybe today is too low. At a 10 cap, you created $48,000 worth of value. You could say that the market is somewhere in between a $96,000 and a $48,000. So let's just say you created $70,000 worth of value. That's probably a 7 cap or something like that, okay? Harder to do in your head, but it's somewhere in between.
You got good math, good math skills.
So you created $70,000 worth of value. You spent $15,000. You created $70,000 of value. You also are getting, let's call it, as some people would say, a 30% return on that investment by the extra $400. Mm-hmm. Do it 10 times in your 10-unit property, okay? You've now, at $70,000 per unit, you've now increased the value of that real estate $700,000. You spent $150,000, $15,000 times 10, to get there, okay? So you say, well, that's wonderful. How do I realize that money? 2 ways. You could sell and then go and do it again.
Or refi.
Or you can go to a bank, and a bank will easily give you, even today, 60%. Let's make it easy. 50% of that $700,000 in value. You spent $150,000 and you just borrowed $350,000 from the bank, tax-free because debt is not taxable income, right? You put it in your pocket to go, hopefully if you're doing this right, to go do it again. Or if you want to spend your money, spend your money. That's everyone has their own, right, what they want. But and you still own the real estate, and it's still cash flowing, and that interest that you're paying on that debt is tax deductible, and. You can't do that with a single family house. And that was a 10 unit. Do it in a 20 unit. You just added $1.4 million, right? Do it in a 30 unit. You just added $2.1 million of the value. And yes, the numbers get bigger, but that's what makes it so exciting. Yes, and it's
because, again, back to scalability, you're probably going to have the same crew of guys going through. You're going to turn units, and yeah, maybe it takes a little longer because it's 30 units as opposed to 10 units, but it's not like you have to reinvent the wheel and have to start over again.
And that's how Connor and I grew our portfolio. We did exactly that. They talk about the Burr method, right, which is basically what you just described with the refinance and then repeat, right? And some of these shows or speakers say, hey, I refi out in 3 months or 6 months. Typically, for our stuff, what we were able to successfully do is every 2 years we were doing a refi where we were pulling our money out plus some from the deal, and then we'd even invest more of our personal income into the next deal, and we just kept doing bigger and bigger deals. And so every 2 years it was a refi for the past 12, 13 years on the deals that we bought. And the way we did that was you don't even have to get crazy. You don't have to immediately gut the whole place. I did do that a couple times, but you can just test the market. Okay, we bought it 1,100 of rents. We got 1 vacant unit. Either we're going to renovate this and just push it as high as we can, or we're just going to put this on the market for, I don't know, 1,100 rents. We'll put it on the market for 1,500, see if that happens. And in some cases, we were able to get market rents without doing anything in this recent, 5-year period. And it's like, wow, okay, so we just created all this value because of the supply demand issue, not so much because of the work we put into the deal. And so now we just made a bunch of money by the way you just described without spending any money.
And that's we do that as well. So we don't go in and clean out a property. Now sometimes we have to.
Yeah, exactly, same.
And the reason that sometimes you have to is now there's the other kind of landlord who knows they're in a rougher neighborhood, they're running a rougher property, they're not running it correctly, and they want to sell, and so they will lease it to anyone who can fog a mirror. They don't run background checks. They get you in. They figure out a way to get you to be able to give a deposit and pay the rent so they can actually claim that on the rent roll. And maybe they don't pay the rent ever again. They're bad tenants. Then good for you.
I've seen closings you've done where they even fudge the rent rolls and they're saying they paid those months. They supply the rent rolls and then suddenly, miraculously, those tenants don't pay as soon as the new buyer
we've done
takes
that.
over.
We've purchased property like that. And those are one of those oh crap moments, right? And you deal with it. You have to. But so you clean out those units first. You call Jerron. You say, hey, I've got a bunch of evictions. You get those people out. You fix those units. You let everyone else stay. And then when those are done, you slowly start. So the other thing is within reason. And remember, there's always this moral issue of trying to be a good landlord, right? But it's still business. You still have lenders to pay. You still have insurance companies to pay. And you still have investors sometimes to pay.
And the government, don't forget.
And the government.
Because they're very forgiving,
exactly.
right? Yeah.
But you start to know when you're doing it the way you were saying, the way I'm saying is you don't do it all at once. You start to understand who your good tenants really are and who your troublemakers are. And if they're a good tenant, let's just say, again, you have a bigger property. So we have a 65 unit, we have a 94 unit. On my 94 unit property, I don't go and raise the rent on 94 units at one time. That would be
chaos.
And it might set me up for a disaster. I might get 20 units back. I don't want 20 units back at once, right?
You might let some go month to month, try to raise a few, see how it goes, and then slowly those month to month, then put them back on higher leases.
So you start to look and you say, okay, hypothetically speaking, you have two people who are both paying the same rent, and one is always out there sweeping the doorstep. The trash is always in a trash bag, tied up in the dumpster. The rent is always paid by the second of the month. They never have loud parties. They never bother their neighbors. And then you have the other person who they put the trash out at the front door on Monday. It's still there on Thursday. When it does,
tied up.
When it's not tied, right? And so now it's all over the place. They open their doors and play the music. You can hear it 2 towns away. Well, whose rent do you think you're going to raise first? In other words, who do you look at and you say, it'd be really sad to see that good tenant leave. I wouldn't necessarily mind if this tenant left.
So let's test this guy. Yeah,
right. You test. So because being a good landlord also means trying to make sure that your tenants have good neighbors as best as you can. I mean, there are legal 100%. Roads you have to go down. You can't discriminate. You can't. You have to. But the tenant who's always a troublemaker and is creating havoc for the tenant who's just a good tenant and just wants a nice, quiet place to live, well, the troublemaker is the one you try to fix. You don't try to fix the good tenant, And so that's how we'll start to say, okay, now we're done. Where do we go next? And we'll look at, basically we'll reward you for being a good tenant.
Yeah.
So have you been the last couple of years? Sorry, you may.
Go ahead.
Have you been rehabbing almost all vacancies? That's your policy across the board, more or less? And almost all your multifamily?
Yes and no, and here's what the no part is. So by way of example, we have a property, 2 properties, one in West Palm Beach and one in Fort Lauderdale, where we're doing the renovations, and then we have another one we have a bunch that came back, and if they come back at all at the same time, let's just say, and you're doing the renovations, and you have tenants who want to lease. Yeah. But you're like, well, it's come back in 6 weeks. Well, what are the chances of someone coming back in 6 weeks?
Slim.
So what you do is you try to look at some of these units and say, okay, can any of these units get to a standard with paint and cleaning and whatever to where you can lease this to somebody else and not feel like you're doing the wrong thing?
Yeah.
Right? And so those are what we'll call partial flips or partial rehab. So if I can go in because the prior tenant was actually clean and neat and didn't, the cabinets weren't full of,
They're not crumbling.
right, and full of gook and we could go in there and put in a new refrigerator, put in a new oven, paint the whole place, maybe replace the flooring and call it a day. And that I can do in a week, for a lot less money. We'll do some of those because we have to have inventory, so when someone comes, we can lease to them, and we'll just know that unit still needs to be maybe finished one day. One of the things that we're trying to do, though, an interesting tip for those of you who have multifamily, especially multi-level multifamily, anywhere, even in San Diego, but absolutely in Florida, water is your biggest enemy. Just by far, water runs and
flooded
ruins,
toilet coming down to the first
everything.
floor. Sure.
And the flooded toilet, sometimes there's not much you could do about that.
Right.
Although I will tell you, at some point, the government should, local government for sure, but they should ban, capital BAN, flushable wipes. They are not flushable.
And female hygienic products.
Well,
too.
okay, but those
we
people
see that periodically.
right,
That's plugged up.
But
a lot
those
of our
people
toilets,
know they're not supposed to flush, and sometimes they do. Flushable wipes. It says it right there. It's flushable. But they're not. And what happens is, so let's go with why are they flushable? Well, technically, a flushable wipe will decompose over time. A baby wipe won't. Okay, and that's why you're not supposed to flush baby wipes, because they will not break down over time. But a flushable wipe, it takes time to break down. It doesn't break down as quickly as toilet paper. And those flushable wipes, they get, especially if there's a little lip in the pipe or a root, they get caught.
Plumbing.
It's a nightmare.
Cast iron, yeah.
It's a nightmare.
Yep.
But so you can't avoid the toilet. But the thing that we've learned, and my guy that I brought from San Diego, his name is Joe, who's just a rock star. He taught me this, early on, is if we're doing a unit, it's older properties, if we're doing a unit on the first floor, even if the second floor is occupied, 90% of the time, sometimes 100% of the time, but sometimes he just can't, but 90% of the time, when he's in that bathroom redoing the unit, he will cut open the ceiling in that bathroom and replace all of the drainage pipes for the unit up above from the unit below. You don't have to go in there and knock on the door and say, hey, I got to come in here real fast. And you're not disturbing the guy up above. But so what he's doing for me is he's saying, I'm giving you a brand new unit on the first floor, and I'm eliminating 80% of the reasons that the second floor is going to ruin the first floor by replacing all of the old cast iron drainage lines, whatever, with PVC. Yep. It's easy. He cuts the ceiling open and does it, patches the ceiling up. You'd never know he did it. And so we do that kind of preventative stuff so that because we plan to own it.
That's like you said, the 20-year own. Yeah.
Right. Even the risers, we cut right there. We put the new big 4-inch risers in, and we go all the way to the top if we're doing the renovation, especially if we're doing top and bottom at the same time, right? So it's just like that actually has changed the game for me on a handful of buildings where we know the cast iron under the building isn't great, so we'll jet that because that's a whole other can of worms to a huge cost to deal with that. But when we changed the risers, we noticed we weren't getting the cast iron leaks in the wall going up and getting those smells or whatever as that cast iron might break or
right.
And so now even if it backs up a little bit, it backs up and then it eventually gets cleared out, so it comes down, so you don't have this like huge leak as the whole system backs up and now all of a sudden you're like getting leaks from the walls. Right. Yeah.
See, so now this, by the way, because you've asked me before the differences between commercial and multifamily. In 10,000 feet, let's just say, you might have 10 or 15 units, which means you have at least 15 toilets, at least 15 bathroom sinks, and 15 kitchen sinks. So in that place alone, you've got 45 drains, at least, and you've got 45, supply lines. Let's just assume hot and cold is one for a minute, so the math is easy, right? 45 supply lines. You have 45 twice opportunities for water issues. I could have a 200,000 square foot industrial building, and it might have 4 toilets, 4 sinks, and a break room, and it's all on grade, right? Yeah. You're not leaking down below, and so there's different problems or different issues. I mean, you hear about people say, I don't want multifamily because I don't want to deal with toilets and tenants, right? Well, that's true. You're dealing with many, 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 many more toilets in multifamily than you'd ever deal with in commercial. And in commercial, it's more than half the time the tenant's responsibility to deal with it. Office buildings a little bit different, but in retail and in multifamily, in retail and in industrial, it's the tenant's responsibility. So you don't even hear about it,
right?
And so that's the difference.
Sure. And I think if you're going to be a self-managing owner, which I was for my first 10 units, I self-managed, and yeah, I was getting those calls. I was getting the toilet at Saturday at 3 a.m. a text message from my toilet's overflowing. What do I do, and how do I turn the water off? Those aren't fun, but you price in management fees, and your financials and your pro formas, and you let your property managers handle that. I'm not saying there aren't costs to it, but as long as you're incorporating those costs in your financials, it's
We've again, this is an Amos Krauss lesson I learned, is although we are doing it a little bit differently right now, and in my opinion, the jury's still out on whether we're doing the right thing, but Amos always believed, as long as you had the size to be able to do it, that you hire people in-house. You don't do it all yourself. You get other people, but you hire. So if you had the ability to hire the in-house property manager, or the in-house maintenance person, or the in-house leasing person on the commercial side, you have 100% of that person's time and dedication while they're at work, obviously. They are yours. All of your interests are aligned, as opposed to when you hire a leasing broker. And I have some very, very good friends who are leasing brokers. I was one, as I told you. And to this day, we now, again, this is a somewhat new world that Krauss is going down, but we are outsourcing a lot to property management and to leasing brokers and so on. When we outsourced, ironically, the day we pulled the trigger was, I'm not kidding you, like 30 days or 15 days before COVID. Oh, wow. We got all these employees, and immediately, and all of a sudden, now we outsourced, but which is good and bad. But we learned. So we started this experiment, three something years ago. About a year or maybe a year and a half into it, we realized we needed to hire somebody in-house who would at least help us oversee. Now, it's a big enough portfolio, but help us oversee all of these third-party property managers, because they have many, many, many clients, and you don't want to be the pain in the butt, but you still have to be a squeaky enough of a wheel that they're paying attention to you, because otherwise you're not, and so we use third-party leasing now, and I talk to my leasing people as often as needed, but every other Monday, whether they have something to say to me or not, they have a half an hour in my calendar where we are getting on the phone and talking about the market and talking about, and part of that is it still takes an entrepreneurial mindset or a creative mindset to say, if you have again, commercial, you have a commercial vacancy that's sitting too long, you have to start to figure out, okay, what do we need to do? So hypothetically, it's an office space, right? And there are no tenants running around in this little submarket that are looking for this type of space. Well, what I've been known to do is tell my brokers, okay, tell me if there are any tenants in the next submarket that are looking for this type of space, because maybe we need to go and meet with that tenant and incentivize them and show them why they might like our space. Because if it's an office tenant, they could, maybe it's an extra half a mile, but you might be providing them with a better deal or whatever it is. You have
Or
to get
break it
creative.
up into 2 spaces or 4 spaces.
however
and
it is.
maybe
So-
people are looking for smaller space. Yeah.
So
yeah.
brokers, and no offense to brokers, like I said, I am one myself too, but they only get paid when they do a deal. And so they tend to work on the deals that are the easiest to do so they can make the money the fastest. It's just human nature, right? And so when you do outsource, you need to stay on top of them.
The incentives aren't perfect,
Right.
but they're good, but they're not perfect.
Right.
Yeah.
But you only,
Yeah.
but at the same time, you only pay when it's good news money. You don't mind paying the commission, and that's actually another thing that you know. I'll tell you a story. Actually, there was a guy named Steve Soberoff. He actually ran for mayor in Los Angeles. He didn't win, but he was a broker / developer in L.A. County, and was a great guy. He actually got involved in a whole bunch of Playa Vista, which is a big development by LAX, but he's just an icon in the business. And I forget what city it was, but the city had a problem, and they couldn't figure out how to solve the problem. And it went on for a long time. And they were suffering because of it. And he says, I can fix the problem. He says, this is what it's in. But when I make this problem go away, here's what my fee is. And it was like $200,000 or something. It was not a little bit of money, but the problem was big. And I said, okay. And they signed him up, and they signed the contract, and he went to work. And I think he had the problem solved in like 60 days. And they were going crazy. Like, my God, 60 days, you $200,000, you're a criminal, how could you? Right? Well, but so he said to them, he said, no, it took me 35 years to learn how to solve this problem in 60 days. And you had this problem for 2 years before you hired me. And so, yeah, you should be thanking me. So a lot of times when I look at people and they say, the broker made so much. I can't believe how much money the broker made on that deal. First of all, 10 deals didn't happen that broker worked on before you. And I know that's not really your problem, but the broker works lots of deals that don't happen. And secondly, you knew beforehand what the fee was, and you chose this broker because you had an outcome that you wanted them to achieve. And if they achieved it, they earned their fee. So you shouldn't be afraid to pay good news money.
And I tell people, like to your point, they're like, oh my God, this deal was so easy and I paid you so much or something like that. We have that conversation. I'm like, yeah, it was so easy. Maybe I should have had a higher fee, right? Right. So because I made this so easy compared to what you've said you've experienced in the past with other brokers, right? So
good way
so
to
it's like,
twist
yeah,
it. Yeah,
right.
it's like,
yeah.
Well, but I mean, the other thing you want to say, which they don't really care, is that, well, you know, what about all these deals that I've done that it took me 7 months
They don't care.
and all the hard work and the 500 showings.
And they
shouldn't care.
But
But
still,
that's a part of it.
Well,
Yeah.
but this is an interesting lesson that comes to real estate, but goes to any other business. And I wish somebody taught it to me when I was a kid. And I tell as many young adults right now as I can this story. But human nature, whether it's in real estate investing or whatever else you do, human nature is, if I'm going to start investing in real estate, I did the same thing. You know, I'll buy a little fourplex, I'll buy a little duplex, and I'll figure it out.
Start small.
And then I'll start small, and I'll figure it out. So if I make a mistake, it's not that big of a mistake, and then I'll move on. Well, let's go out and take away real estate for a minute. Let's just say you're a real estate broker, or you're an insurance broker, or you're whatever it is that you're doing, okay? But let's use real estate as an example. Human nature says, I got my broker's license, my sales license, whatever. I got my license. I'm going to go out, and so you know what I'm going to do? I'm going to start selling a couple condos, and I'll figure out how to sell some condos. And then I'll start to move up, and I'll sell some homes. But what I really want to do is I want to get into the multi-million-dollar homes. But, you know, let me start selling some condos. And that's human nature. I will tell you, and then we'll actually walk through the thing. My daughter, who now wants to buy a place, right, with her fiance, my future son-in-law. You know, it's still hard to swallow that one. My future son-in-law. They know how much they want to spend, and inevitably, you always wind up stretching above your number. Always. It just, you know, our budget's $500,000. Now you're looking at stuff that's $650 or $700. Bad enough that interest rates are now 7%. That's hard too. which by the way is still historically low. I remember my wife and I bought our first condo in Mission Viejo, California, and I did a dance in the streets because my interest rate was 9.75%. Wow. I was under 10%. Yes, But back to the point. My daughter and my future son-in-law, they have this budget. And so Larry, you're like, okay, let me show you. I know that you told me you only want to spend $600, but you got to check this place out. It's $700,000, but you're going to like it. And you're going through and you're showing them around, and then you get to, the bathroom. And the bathroom is, black with purple polka dots in it. And you're like, I can't. How can we live in this black bathroom or whatever it is, right? Just whatever, I can't. There's flowers everywhere, and I can't do this. We're going to have to redo this bathroom. Well, let's just say my daughter says that. Right? We're going to have to redo this bathroom. Well, now my future son-in-law is already like, oh my God, Larry's already showing me this thing that's $700,000. Now I got to redo the bathroom. That's going to cost $15,000. And then with this, and then this, and then this, and we can't do it. And he's up at night and he's stressing out. And fast forward to for a minute, next deal, you're trying to sell a somewhat successful now 30-something accountant or lawyer or whatever it is who's having a kid, a $3 million house or a $2 million house. And they walk through the house and flowers everywhere, right? Now you know what you're doing? You kind of laugh, look at this bathroom. Can you believe and you move on because your plan at the $2 million was to tear it all out anyway, right? Because that buyer already knows we're going to buy a house for $2 million, we're going to spend $300,000 on it, make it our house, and, we're going to, and so it's a much less stressful, it's a much easier sale to make because that emotion, that fear, everything about it is out of the equation that the first-time home buyer who's stretching doesn't have. And so then you say, well, but how do you convince the $2 million or $3 million buyer to hire you? And I look at it, I said, if you're going to sell a $600,000 house, okay, you have to sell 5 of them to earn the fee that you need to sell one $3 million house. So you might get lucky enough if you're aggressive and a good broker knocking on doors or insurance, whatever it is you're selling, you might get lucky enough to find a person to let you represent them every other month on the $600,000. So you get 5 of them in a year, right? Okay. It might take you 8 months or 9 months to find the $3 million buyer. But at the end of the day, you worked on one deal, and
still
so
ahead of the game.
And how do you? This goes back to our thing before. So how do you find that $3 million buyer? Fortunate enough, just to go on a side for a minute. Fortunate enough that I now live in a place in a country club here in Delray Beach where we're surrounded by other very successful people, and so I've been able to show. So you can there could be a guy sitting at the next table over who can probably buy me my entire net worth with the change in his pocket, type of thing. But if you look at the guy on a Sunday, he's wearing a T-shirt that's probably got a little hole in it. He just came from the gym. His socks are down around his ankles, or he just got done. And he just looks like a guy. And you know what? And or he's not. He's dressed nicely, whatever it is, but he's just a guy. And you walk up to the guy and you talk to the guy or woman, person, and you have a great conversation with them, and they're really nice, and you share a laugh, and they say, hey, we should go hit tennis balls one day. And you go hit tennis balls one day with them, and you have no idea until later you find out, my God, they what? They own half of Chicago? Really? They're worth that much? But before that, before you knew they owned half of Chicago, or before you knew they owned 15 McDonald's or whatever it was, and they were worth a ton of money, they were just a man or a woman. They were really nice. They told you a joke. They hit a tennis ball with you. You spot them at the gym, whatever it was. They're just people.
Yeah.
And so I try to teach, and my kids, fortunately, because they come visit us, and now one is kind of living with us for a while, I hope they're learning that, because then you know what happens? You start going to networking events, back to what we were saying earlier about pressing the flesh. You get in front of people. You don't lie, right? You say, look, I'm getting started. But you start providing knowledge, market information. Hey, I know you're looking for a house, by the way, in this neighborhood. Look, these are the 3 homes that just sold in the area. By the way, I just heard about this. You're providing information. You're showing that you're competent. You're showing that you're smart. And you know what? I'm gonna say 90% of successful business owners or successful entrepreneurs or successful people, man, woman, nationality, doesn't matter. 90% of the people who are there weren't when they started, and they see you. And they see that they see your fire, and they see that you're competent, and they see that you're courteous, and they see that you're honest, and they're going to give you a chance. Yep. Because if you don't perform, so what? Then they'll find someone else. But they're going to give you a chance. And so the moral of that story, whether it's selling insurance or selling real estate or buying real estate, is bigger, takes less work, and is easier and is more profitable than starting smaller. There's more room for error in big work, in bigger deals. And then you say, well, and as you said before, when we started this thing, the only difference in a big deal and a small deal is the number of zeros. I can tell you this, and you have all been there already. First of all, 100% of nothing is a lot less than 20% of something, whatever the something is. Or 100% of nothing is a lot less than 10% of something. And so if you have to go and find your first deal and it's got a lot more zeros on it, and you need to go and find somebody else to put in the bulk of the money, or even to help you do the work in the beginning, and you give up most of the deal, you're in at least.
We talked about that the other day, syndication. We're not going to go deep into that here, but but even if it's not,
it doesn't even need to be syndication.
Right, it could just be finding money partners. You
come to a guy like if you're a young professional in the business, you're trying to get started, and you find a little 20-unit deal. You're like me. You were looking for 8, and you find a 40, and you're willing to do all the hard work, and what you need is several $100,000, a few $100,000 or $1 million. I mean, maybe that is me, maybe that's not me. It depends on what day you ask me, right? But you're going to find it. You have to show me the deal works, and you have to show me my certainty that I'm going to get my money back. But I don't necessarily have to knock it out of the park to help you make that deal. And forget me. There are 50 people at my club. And I'm a small club. There's 20 clubs in Boca del Rey. There's 100 people at any of these clubs that would give you the money for a deal that makes sense. So go find the deal. And then you know what? You say, well, how do I find those guys? Larry knows those guys. Sure. Jerron knows those guys. Your CPA knows those guys.
Right.
If the deal works, you're going to find the money.
That's smart. That's really good advice.
That's definitely the right philosophy. Yeah.
It is. Yeah, because so many times you really only think about your capabilities financially. I've shared this before, but just like you're talking about, I started off playing small ball, buying a condo or two, and then a quadplex and a triplex and another quadplex and another quadplex, and I kept doing that, and then I bought 2 sixplexes, and the sixplexes were a jump up because, as you said, once you go above 4, it's commercial. I wanted to test the commercial market and see how commercial lending worked, and it's just a slightly different transaction. But once you get outside of the mindset, which I'm getting into now, of possibly finding money partners in syndication and exploring that, it opens up a whole new world of possibilities. When other people are giving you the money, you're the general partner on the deal, or whatever it is, or they're just partnering with you in an LLC and you have an operating agreement. However you structure it, it opens up a lot of new possibilities.
Let me show you one more thing on what you just said, which is interesting. Is human nature? You're buying smaller because you're perceived in your mind anyway that you're taking less risk, right? Because you don't want to go too big is too risky. But remember, deals are deals. It's just the zeros for a minute. So let's just pretend for a second that you put $100,000 into a deal, right? And you're expecting a 10% return. So it's going to throw off $10,000 a year to you. $1 million into a deal is going to throw up $100,000 a year to you. $10 million is going to throw off $1 million, right?
Yep.
Basic math. If you have, just to continue the thought for a minute, if the $100,000 investment that's throwing off $10,000 is a duplex. And so the $1 million one, let's just use the same numbers, would therefore be a 20 unit, right? Because 10 times, right? And the $10 million one then would be a 200 unit. The numbers work for this example, but you'll see where I'm going. Your duplex, which is throwing off $10,000 a year on a $100,000 investment, you have one vacancy. What are you vacant?
50%.
50% of your income's gone. Yeah.
On the 10 unit, you have one vacancy.
10%.
10%. Yeah. You can afford to carry a unit that's 10%, a property that's 10% vacant for a period of time until you fill it. 50% vacancy, you are taking on water fast. And unless you can figure it out or bail yourself out, that ship's going to sink. Mm-hmm. So bigger allows you to have issues that the ship can sail through also.
I think if I put myself back to 2010, 2011, when I first graduated and started doing the same thing, buying the duplex. I bought a duplex, I moved into one side.
Well, that's great. House
this
hacking,
works.
right?
Yeah, this works. Okay, let's go do another duplex. Okay, we'll go do another duplex. And so, but at that time, I had looked at bigger stuff, and some of these bigger things made sense, but I wasn't in the mindset of it's okay to think big like that. And like now, in hindsight, it's like, man, that's where I should have been. I should have been, even 10 units were big at the time. So I should have taken down that 10 unit deal instead of doing that duplex and then another duplex a year later, right? I would have been
stretch yourself a little bit. Sure.
Yeah,
every one of us play that should have, could have.
Totally.
Every one of us.
Yeah.
And I do that a lot. There's many I should have. I mean, that first deal in Riviera Beach, on that day that I tied up that property, I actually tied up two properties, both comparable in size, and ultimately said I walked away from one and only did the other. And if I had only done both, I mean, should have, right? I mean, but every day. And even though we all beat ourselves up that way, the thing that I look at is, well, I did my numbers right. I knew I was right. Why didn't I act? I should have, or I didn't. And you say, well, you know what? Here's the thing, and
that's what happens when you play the game.
Yes,
right. That's just the answer to that.
Well, and in the beginning when I was first doing the smaller deals and I wasn't doing it with Krause and I don't necessarily, like I said, it's the formulas are all the same, but you don't sit and talk with a young person or even one of your own counterparts about a $100 million office building that I'm doing with Krause, because that's just outside of most people's realm of even understanding, right? Mm-hmm. Even a $50,000 or a $50 million or a $30 million or even a $20 million deal.
People's eyes glaze over. Yeah,
because you're not exciting anyone about that.
Right.
But if I sit and talk to you about a $2 million deal that you might need $400,000 for, and here's how much money you can make, and I go through that, you raise the rent $300, and now you're getting excited. And my wife used to say to me, "Why are you telling everyone the secrets? Aren't you, worried that they're gonna, And I got to tell you, there will never not be enough deals out there for everybody. Why everybody isn't doing it is it's fear, right? And it's fear of the unknown. It's but there's always deals.
And fear, which creates paralysis, but it's also laziness. Let's be real here.
Laziness.
I mean, I'm not saying that. I'm not always in the mode of working my regular 8-9 hour job as a lawyer and running my law firm and then coming home and then starting another 2 or 3 hours of property searches, and underwriting deals. And I'm not always in that mode. So I even share in that, sometimes we go through periods, but some people just never dive in because they're just, they like to hop on Netflix at 6 o'clock.
Right,
and,
right. So I look at it as, first of all, I like to help people. It's always, because what goes around comes around. You make a lot of good friends that way. A lot of times these people are my friends, and so if I can help them, they're my friends already. I can help them, great. And I want to put an asterisk on that. There will never not be enough deals. That doesn't mean that when markets are out of whack, which I think they are right now, that you force deals to make sense.
Agreed.
You have to wait for the right deal. I had on Krause, we do much larger deals that have much bigger numbers to them, and so lower returns even can make sense. If you're building to an 8 cap, an 8% return on a $50 million deal, that's still real money, as opposed to an 8 cap or building to an 8 cap on a $1 million deal. Not that an 8 cap's not a good thing. I just am using that as an example. And I want to show you another trick about leverage in a minute too. Don't let me forget. But the underwriting criteria that I had on my deals for me to be able to, kind of like the red light, green light, what gives you the green light to go is, and what I'm about to tell you is very, very hard to do right now, if almost impossible, right this minute. But I wanted to see a path, so within 2 years, of being able to get a 10% cash-on-cash return, and I wanted to see a 5 to 7 year internal rate of return. I don't want to make people crazy, but an overall return that was at least in the high teens, if not more.
Levered.
IRR. And we'll talk about leverage in a minute. And if I couldn't do that, it was a pass. Now, there's many deals I passed on that I wish I did today because the market has done crazy things. It's very hard to find that right now. One of the main reasons it's very hard to find that is because of interest rates. So let me show you a trick, by the way, which I've had much smarter people than me tell me there's no way that works. And I'm like, do the numbers. And they always like, wow, that works. Close enough, okay? So if you cut a pie into four equal pieces, each piece of the pie represents 25% of the total pie, okay? And by the way, this is how you look at a deal and you say, can I make money, right? If you cut the pie into 4 equal pieces, okay? If it was 20%, it would be 5 equal pieces. But these days, lenders want a bigger percentage down, so let's say 25% down. So 4 equal pieces. If you buy a property that's, let's just make it easy for this example, and this example worked a year ago, it doesn't work right now. But if you buy a property at a 5 cap, okay, that means you put 25% down, your cash is earning an annualized 5% return, 5% interest rate, so to speak, okay? The bank is giving you 75% loan. Each piece of the pie is 25%. They're giving you 3 pieces of pie, right? They're going to charge you, this is a year ago, they're going to charge you 3% for that money. So this piece of pie is earning 5%, but you're giving the bank 3%. You get to keep the 2%. Mm-hmm. This piece of pie is earning 3%, about 5%, you're giving the bank 3%, and so on. So you are earning the arbitrage, the delta, between what you're paying for the money and what the money is earning, 2%, 2%, 2%. Trust me when I tell you, 2 plus 2 plus 2 equals 6. This one's earning 5. 6 and 5 is 11. You're making an 11% cash-on-cash return because of leverage. If you paid 100% cash, you'd be making 5%. The power of leverage. The reason that doesn't work today, and the reason the markets are out of sync today, is, remember, in that scenario, your cap rate was 2%, 200 basis points, above your interest rate. Mm-hmm. That was the spread. And that, historically, is what it should be for you to take the risk of doing the real estate, right? Interest rates today are 7%. Let's use the same example of a 5 cap, right? Okay? Let's make it easy for a minute and use a 6 cap, okay? Because that means that the price of the real estate went down. So your 25% is earning 6%. These 75% are at 7% interest rate. That's what the interest rate is right now. It's what it is, 7%. So 25% is earning 6%. This is earning 6%, costing you 7. This is earning 6%, costing you 7. This is earning 6%, costing you 7. 1, 2, 3% loss from your 6%. You're now earning 3%. Well, I can show you 19 places where you can put money right now, earn more than 3%, never get out of bed. Any bank, any money market fund, any treasury bill, any broker can earn you more than 3%, safe, never get out of bed. So why would you buy the real estate? Which is why very little is trading right now, because the sellers and the buyers have different expectations. And eventually, it's going to have to correct. And unfortunately, for the formula to work, there's only two ways that formula works right now. Is
Interest
values
rates go
come down.
down.
Interest rates another one, but it's going to happen, but it's not going to happen quickly.
It's going to take time.
So values have to come down, prices that you pay have to come down, or the rents have to go up substantially to make up for that. Otherwise, you're not going to do it, right?
And rents cannot go up substantially based on the increase in wages.
They can't.
They're not increasing. They weren't increasing at the same pace as inflation the last few years. So, and they're just not.
Which is why nothing's trading.
Of
And by
course.
the way, forget the 10 unit, $100 million shopping center, a $20 million shopping center. The only thing right now that doesn't seem to be affected by this, which is a mistake, is industrial distribution. It's still trading at cap rates that make no sense because it's the favored class of real estate right now, because the institutions feel it's safe, because they think that we are becoming a world of logistics, internet, online ordering, and everything needs to be supplied last mile, or even across the country shipping, and distribution is key. And that has to not work, because you got to remember something. When you invest in, let's just pretend you buy life insurance, and your life insurance guy convinces you to buy the whole life, the variable life that grows in value over time, right? You're not buying the thing you see on TV for $19.99 a month. You get $500,000. You're buying life insurance that also can act like as an investment, right? Well, your insurance broker or salesperson who's showing you the insurance has to show you, well, you're going to earn, we're going to show you you're going to earn, 8%. It's got to be a number that's higher than you could get in a CD right now. Well, why would you do it, right? And so, if that life insurance company is telling you they're going to pay you 7 or 8%, right? They have to earn more than 7 or 8% of that money, because they're not in the business of making money to give it all to you. They're in the business of making money so that they can pay the death benefit and still pay all their people and then some. Pay their CEOs 7 and 8 figure salaries, and I mean, there's money in that business, right? Life insurance, regular insurance too, a whole nother story. But so these life insurance companies, these pension funds, same thing with a pension fund, the teacher's pension fund, they have to earn a rate of return that's respectable, right? And they do it by investing in things, real estate being one of those things. Well, if they keep buying industrial real estate at 4% returns, because they think they're betting on appreciation. At some point, that appreciation is not going to happen, and they're going to take a step back and go, whoa, we're not performing the way we told our investors we would. We either need to sell it and put it somewhere else, or let's not sell it, but let's not buy anymore. And when they don't buy or let's change our underwriting criteria, right? Mm-hmm. In any event, you dry up demand, and the supply is there, prices will adjust to meet demand. And so prices are going to have to drop. Or because interest rates, and even if interest rates go down, they will not be 3% again for 3 or 4 or 5 years. And here's the thing, regardless of the fact that our Fed is supposed to be independent and not political, they are going to they won't raise and they won't lower next year. Right. They're going to do, unless the economy flashes a major signal that they must act. They do not want to appear to be partisan in any way. They will do nothing next year because it's an election year. Mm-hmm. And so they're already talking about one more raise this year, next month, or whatever it is. Yep. And then if they stop there, great. I don't think that they're going to raise a quarter point in August and then lower in October. Mm-hmm. So they're just going to coast, which means they'll probably coast for the next 15 months. Right? And then when they start to lower, remember, there's 2 reasons they raised them this far. Reason number 1 is it is a brake on the economy, because it takes money out of the economy 2 ways. It makes it more expensive to buy, whereas, I mean, look, regardless of what I may or may not be worth is irrelevant. I work hard for my money. I still respect my money. I still think about my money. And therefore, the car that I could have leased last year is now, because of interest rates and money factor, is now $500 or $600 a month more than it was last year. And I'm sitting here going, you know what?
Nah.
My car's just fine.
I agree.
You know?
I know, yeah.
So
I'll be buying my lease.
Right.
Yeah.
So what did I do? I didn't take that money and spend it. Right. The economy is slowing down because they raised interest rates and they made me go, whoa. So.
And less lending too. So remember,
Right.
banks create money out of nothing.
Right.
Essentially, is what they're doing. So they're creating money by leverage, and now banks are tightening up their standards.
Right.
And that's causing money to leave the economy.
This is all
Yeah.
a break.
Yeah.
This is what the Fed is doing.
Yep.
Okay. Now, some people might say they're doing it too much or too fast, but remember, just like your car has a brake, your car also has a gas pedal. And if you don't have any gas in the car, the gas pedal doesn't do anything. So they are giving themselves plenty of room to accelerate the economy
Later
when
on.
they need to.
Exactly.
They have to save those bullets for when they need to.
Yeah.
So that's, and you say, what does that, for people who don't understand, what does that mean? Well, just like raising interest rates makes me think twice, if all of a sudden they say they drop interest rates, well, now I'll go get a car, or I could buy a house, and you know what? We're small potatoes. We don't even count. It's the big company that goes, wow, they lowered interest rates, and the government is giving me an incentive through depreciation, whatever. We'll replace $50 million worth of equipment.
GM
We'll
or
buy new airplanes.
Ford
We'll
or
buy
Boeing. Yeah, sure.
That's what spurs the economy. And so there's, look, it kills me. But two things. There's no shot they're lowering, I don't think, until 25, unless something major happens. A true black swan type event. I mean, I don't wish it on anybody. I don't wish it on the world, but something, war, terrorist attack, some major thing where they got to go, COVID, whatever you believe, they pumped a lot of gasoline into this economy by throwing all that money out there.
Sure did.
And we're paying the price right now.
We are.
So unless something like that happens, I don't see interest rates going down until 25.
Agreed.
Okay? And then they're not going to drop them to 3%. They're going to go from 7 to 6 3/4 to 6.5. Slowly, It's just like when the light turns green, you don't slam on the gas, or you shouldn't anyway. You just put your foot on the gas. You let it,
Right.
And so I think I think that there is, and that goes back to what I said earlier about controlling. You can control the real estate. You can't control the stock market. You can control the real estate. So how do you control the real estate? Don't over leverage, because if you're over leveraged, if just like my daughter and my future son-in-law on their first time home can theoretically, because they're first time home buyers, buy with 3% down. Right? I mean, there's loans out there for young people, VA loan, whatever it is. I don't remember but there are loans out there, first-time home buyer, 3% down. But that leaves them, first of all, now they have a big payment and leaves them no cushion for a correction, which you say, well, that's all fine as long as they don't leave. But what if they have to leave? Or what if they didn't get a 30-year loan? Or what if they said, because interest rates are so high, I'm going to get an adjustable rate mortgage, right? And this is the next problem that we're facing. Commercial real estate loans, multifamily loans.
Coming due. Yep.
Well, so they have, even though you might be able to convince a bank to give you a 30-year amortization, they're typically 10-year loans that are fixed for 5 and they adjust after 5. And they're due in 10. Well, the due in 10 isn't scary right now. It's the adjustable after 5 that's scary. So let's forget 23. Let's look at 24. 24 minus 5 is 19, right? In 2019, interest rates were 2.5, 2 3/4, 3%. You put a loan on, you're running the property. If you didn't raise the rent, if you didn't increase the cash flow, if you didn't reduce the expenses, if you didn't right that ship,
If you didn't buy the deal right.
if you didn't buy the deal right, thank you, Larry, exactly.
That's
which
the
I
big
always
one.
say, you make the money on the buy.
Yep.
As people say that all the time. If you didn't buy the deal right, you now have a witching hour, and you have multiple things coming against you. It's not, if you have a note that's due in 10, your only risk is interest rate risk right now, because your interest rate will adjust to, let's say, 7%.
But if you didn't buy the deal right,
Debt coverage.
and yeah, your DSCR,
Your debt coverage ratio might be wrong.
Yeah.
So a bank is eventually going to say, you bought it at $5 million, but today it's only worth $4 million, and we're only going to, we can only give you, 70% debt coverage on your $4 million, or 75, make it easy in my head. Yeah, you owe us $4 million of your $5 million purchase price, but we can only give you $3 million now. You got to give us $1 million. Capital call.
Yeah.
It's coming. And that's what opportunities will be if you wait.
If you wait. So to wrap this up, this has been awesome.
Yeah, sorry, I could talk forever.
No, I love this. I'd stay here all.
My wife tells me
all day
zip
if I could. No, this is fantastic. Learning lots of. I love the back of hand stuff that you always have too. The napkin, back of napkin.
Yeah.
I love a little pie.
You can't do that. Then it doesn't.
Well, that's the only way you can
example.
process that many deals that are coming across your desk, because brokers are just throwing stuff at you all day, and they're not really thinking about, like, is it a real deal? They're just they're throwing stuff at me, and I'm like, okay, that doesn't work. We're not wasting time. That doesn't work. Or I just respond, here's the number that I would consider this at. Are we in the space? Nope, we're not in the space. Okay, let me know. Right?
That's smart.
So, I want to hear what you say, but let me just say one more thing about that. That I've also noticed when you're looking at stuff, most brokers have very high integrity and are trying to do the right thing. But there's two parts of the information that's garbage in, garbage out, right? I mean, you just like with a computer, right? Garbage in, garbage out. Number one is a broker doesn't verify what the seller told them. They can only rely on what the seller told them. Secondly, there are many brokers who get into the space, and I can't tell you how many OMs I've seen, offering memorandums I've seen where they show the income, they subtract insurance, taxes, and that's it. And I'm like, well, where's maintenance? Where's landscape
management?
Where's management? Where's and they don't. Or
they take the
vacancy,
current insurance bill.
Thank you.
Right? It's
current
just like,
insurance. I was going to say
that's the.
I was just going to say the other one.
Current taxes.
Current taxes.
Because taxes get reset. When the property doubles in value.
So you have to know that, and depending on what market you're in, there's rules of thumb. Eventually, you will get it under contract, and you'll drill down deeper. So in Florida, and I could tell you in California, I had rules of thumb as well. But right now, rule of thumb, as scary as this is, in 2018, the rule of thumb for insurance was $500 a door. In 2024, the rule of thumb for insurance is $2,000 a door. It's crazy. But it's actually more. But let's use it's like 22 now. But at $2,000 a door, you put $2,000 a door in your napkin. Right? It's in your worse than that, or better than that, rule of thumb for a minute is before the insurance debacle that's going on right now, you could say expenses should be between 35 and 42% of gross income. So let's just say 40. So I take real back of a napkin, gross income. You have to, even though it's 100% leased, you have to put a vacancy or bad debt, because there's always someone who's not going to pay you, or there's always a vacancy eventually. So do you like 3%? Do you like 5%? Whatever you use. Let's do this in this example for a minute, 5%. 5% vacancy and 40% expenses. So really 55% of your gross income is your net operating income. That's what you apply your cap rate to. If it works, you move on. If it doesn't work, it doesn't work. You move on.
Yeah.
You might say, well, maybe the expenses are 39% and it would work. Maybe they are. But if it doesn't work on the back of a napkin quickly, you're wasting your time. And so taxes, the rule of thumb, which Marcus and Millichap, I think maybe Daniel Cunningham, who's a mutual friend, or it might have been Evan Crystal, who taught me in Florida, they take the purchase price, they take 80% of the purchase price, and you take 2% of the 80%. Good enough for a quick rule of thumb. You'll do it better later, but that's a good, what are my taxes going to be? Well, the taxes right now are $10,000. Yeah, but the guy paid $150,000 for the place. And now I'm paying, $10 million. Well, 80% of $10 million is $8 million. 2% of $8 million is $160,000. That's the taxes you put into your equation. Quick rule of thumb. In California, it was simply, 1 or 1.5% of the purchase price. That was how they did it. And then, 2% annual increases are the most you could do in California. Here, what is it, 3 or 3%? or 10% commercial, 3%
commercial.
10% commercial, 3% residential.
For each year annual, yes, 10% cap for commercial, yeah.
So rules of thumb, and they help you.
3% for your homestead, yeah.
And if the rule of thumb doesn't work, don't try too hard to force it to work. Yeah. Forcing a deal to work is usually a mistake.
Agreed. So, with everything you've said here, you've really properly explained the challenges with the economy, with making deals work, the numbers. What are you looking at right now? What have you put under contract, or what have you bought recently in the last, let's say, 12 months or less? And what do you think your plans are for the next 12 to 24 months?
So on the personal side right now, I'm using this time to. So in 2022, I had a huge rat to swallow. You know, I sold everything in San Diego and brought it over here, and I had to do a lot of buying, some with Krause, some without Krause, and because I'm a value add guy for the most part, I bought things. Everything had a problem, and now I'm using this time to fix the problems because deals are so hard to come by. So I'm not stressing out. I'm saying, okay, let me
take some time.
Let me do what I'm doing, and I'm hopefully going to wait until there's some form of meeting of the minds between buyers and sellers, because right now it makes no sense.
Some correction.
On the Krause side, we still have some 1031 exchanges that we need to do, and in those cases, they're hard. They're hard to find deals that make sense. Yeah. But we're still looking at value add deals, and believe it or not, we are starting to look again at new construction, because if you can't find something that you can add value to, and you're buying it at a price that's not much less than replacement cost, then why not
just get the newest?
Get the new, you know. Yeah. So, and then, again, not to get into politics, and there are some great podcasts and books and people I could point you to, but there's somebody that I've listened to who has said before that the amazing thing about our tax code, and, you know, people say, well, you know, why won't so-and-so show his taxes, or I want this person, you know, why don't people? And part of the reason for that is there are incentives in our tax code to get you to do things that if the average person saw it, they go, my God, this person, and they paid no taxes, right? And so why do I bring that up right now? There are incentives in the tax code right now that our government has put into place to spur development in certain areas, like opportunity zone incentives and certain incentives like that. So we have been looking at, and we're currently developing a big industrial distribution facility in an opportunity zone in Reno, Nevada. We're currently doing a ground-up development of it's kind of office industrial. It's a smaller building. It's, you know, so the 400,000 square foot building in Reno, Nevada will cater more to a logistics company, a trucking company, companies that move things around. The 40,000 square foot building that we're doing in Las Vegas might be more of a regional user, maybe an electric parts distributor, a plumbing distributor, maybe somebody who's in the gaming industry who wants just really cool open space. But it's kind of an industrial building that could be office, but smaller. Again, those are starting to make sense again. Construction costs, while still seem high, are a lot less than they were during that spike from COVID. I mean, things have come back down. So we've been doing that. We still look for value-add deals. I think that there will be an opportunity in office buildings, not right now, but I think it's coming. I think there'll be people walking away and throwing the keys to the bank, and the banks don't want to own these things, and so you'll be able to go in and buy. And so we're starting to remind people who we are, remind people, look at what Krause Companies did. Look at this 26-story building. It was actually a full city block in Phoenix, 26-story building and a 9-story building that, yeah, it was 30 years ago, but we did it. It was 30 years ago. It was the last time there was an office problem, right? Look at this building we did we know what we're doing type of thing. And so we're really working that. We're not, unless we have to, we're not buyers right now because it doesn't make sense.
Doesn't make sense. Yeah, that makes sense. Funny that you mentioned it, though. I've been seeing some YouTube videos on, especially in metropolitan areas like New York City, where certainly high cost for per square foot for condos and rentals, but where there's a lot of conversions of this office space happening, converting either to apartments or to condos, and
It's harder to do than you think.
I bet.
It actually works in, and I'll show you why. How, because real estate evolves, right? It actually works in older and old buildings. So in New York City, a building that was built, I kind of laugh because in California, when I lived in Orange County, California, in the year 2000, a building that was built in 1980 was an old building. In New York City, it's like pre-war,
Right. 1919, yeah.
Right, exactly. So in older buildings, back in those days, even buildings that were built in the 50s and 60s, floor plates were smaller. Office building floor plates were smaller. There were many more windows and window lines. And even into the 80s and 90s, it was kind of like that. But at the same time, you go into the 60s and 70s and 80s, and you started to have back in the earlier days of law firms, as an example, every lawyer had a windowed office or the corner office, but then there was the whole secretarial pool or legal professionals or whatever, the paralegals were all interior in these cubicles and the typing pools of the 60s, just a lot of interior space. Well, then you come into the 21st century and lots of places went to open plan, very few offices, lots of cubicles. The tech companies all went with big open plans, and floor plates went from, on average, 15 to 20,000 square feet in the 80s and 90s was an office building would have a 20,000 square foot floor plate. But older buildings might have 15 or 18. Now today, 21st century buildings, they might have, especially in cities, 30 or 40,000 square foot floor plates because big open plan, law firms, brokers. You go to CBRE or JLL, big commercial real estate companies, and all their new offices have no offices. Big open space cubicles, and then interior breakout rooms and conference rooms, and everything is open plan. Lots of big floors. And so, two problems with that. They were built as office buildings that was supposed to be big, like WeWork type spaces, right? When you put in a 15,000 square foot floor for a minute with lots of windows, it's a narrower floor, lots of windows. Maybe you're going all out and you're making them. Let's say it's 16,000 feet for a minute. You're making 2,000 or 15,000, 2,000 square foot units, right? And you have a core. You have a hallway and an elevator and stuff, and that takes up some square feet. So you could put 7 units on a floor, on a 15,000 square foot floor. And they're big units, they're 2,000 feet. So a 2,000 square foot unit probably is a 3-bedroom, 2-bath, right? Okay, maybe it's more. Maybe it's 3-bath. But remember, a bathroom has a tub, a sink, and a toilet. Those all require holes in the floor. The kitchen sink requires a hole in the floor. You're drilling holes in a floor in a structure that was designed to be held together by that floor. This office building it's structural.
Engineering-wise, it's tough.
Right.
Yeah.
Not only that, now go to a 30,000 square foot floor. And let's just say you're doing 2,000 square foot units. That 2,000 square foot unit might have 2 windows because it's a deep space. You can't do. Who's going to buy a 2,000 square foot condo with 2 windows in it? So you can't convert it. Newer buildings, now fortunately, there's flight to quality, so people who are leasing office space at least are going to the newer buildings. But any building that was built in the last 30 or 35 years will have a very difficult time being converted to housing. It just doesn't work.
I bet.
No one thinks about that.
Yeah.
So.
Yeah, that's. I think here in South Florida, we don't. That's not going to be realistic here.
Wasn't Jeff Green in West Palm trying to do that in his 2 big office towers for a minute? And I can't remember if he won that battle or not.
Yeah, I don't know either.
He was trying to do that.
Was he really?
Well, and then that's another problem.
But the other thing is that we do have jobs moving here in South Florida. So it's more about these places, San Francisco, New York, where jobs are leaving or were leaving during COVID, and maybe some are coming back. But that's where you have all this vacancy. So
it's there will definitely be some form of repurposing or repositioning.
People will find solutions to it.
They
always will.
Capitalist society.
Capitalism
wins
wins in the end.
And honestly, although I don't know if it'll ever be what it was, I really do believe people will go back to work. I don't know if it'll be 5 days a week, 350 days a year, but whatever 5 days a week is.
It's like what I call flex schedules. We have that at our law firm.
And unfortunately, if you want to attract the current labor force, you have to be a little bit flexible. Mm-hmm. But again, without getting political, I think the biggest crime that COVID has created on our country, and the biggest crime to us maintaining, global world dominance, right, is when the young generation doesn't go into the office, they don't learn from the older generation. They don't get mentored. There's no hanging out at the water cooler, or forget even that. There's no two young professionals who are lawyers who work for a firm who are working from home never go out to lunch and say, you know what? Why don't we go create our own firm?
Exactly.
Or why don't we go? I can write an app. I can make let's go create a new company. Let's go and
it doesn't
happen.
Or back in the late 80s with you, if you were never in the office, you would have never had the opportunity to sit there at that workstation and learn
or have those guys realize
build
how
value,
right?
Because you wouldn't have had that at home, at least for another few years, and by then your skills would have been.
But those guys wouldn't have known that I had those skills,
right?
Right,
all of it. It ties together.
There is so much to be said. Let me tell you something. College teaches you how to learn, but very little about what you've learned in college you ever use other than when you're watching maybe Jeopardy, right? I mean, think of it. I mean, there's history repeats itself, so history is very important to know, and it's important to understand how our government works, and it's important to understand accounting.
I don't use my calculus,
right,
or my trigonometry.
But and even when you had to write papers, you learned how to organize your thoughts. You learned how to. But then it's in the field is where you learn what you're doing. You've learned how to learn, and now you can learn in the field. If you're sitting at home, what are you learning?
You're not growing.
And that's terrible for the future of our country, because we're still here, and we're still from the pre-COVID world where we're still out working and we're getting. But if everybody was allowed to work on the couch, and log in at 9 and log out at 5 and take unlimited vacations. I mean, fortunately my kids are they grew up in my household and they saw how my work ethic. But they technically both work for big companies, and they have unlimited vacation. You need a vacation, you take a vacation. Now, they don't take advantage of it, and I think people who do don't last.
Agreed.
But they are not 2 weeks. The first year you get 2 weeks. The second year, you get, at 5 years you get 3 weeks. None of that stuff like we used to have. If nobody's there to show someone a work ethic, and that's all they know, it starts to be, and it's just bad for our country, I think.
I agree. Well, hopefully we'll at least come back to somewhat of a semi-normal work schedule, and
I think people will start going to work. I have one daughter in Manhattan right now, and she's 100% remote, but she's in financial services consulting. I won't say what company she's with, but it's a big company, and they have her going into the office right now in the city 3 or 4 days a week, because they're on a special project, and so they want everybody to come in. That special project has been gone 2 months already. I just think that this is the way they're kind of getting them back into the office.
That's very smart.
So I think it's coming. You know what you don't realize, what people don't realize when you talk about our economy, how many, let's look at the industries that have been decimated or been destroyed because of this remote environment. Let's start with the husband and wife who own the sandwich shop down at the bottom of the office building. And they made a respectable living selling breakfast and lunch, no dinner, 5 days a week, not including holidays, right? Because Washington's birthday, everyone's closed, whatever. In Manhattan, all of the coffee shops, the pizza shop, the whatever. How about the dry cleaner? How often do you need to get dry cleaning now if you're not putting on a suit and a tie every day, right? The shoe repair guy. No one really even realizes the amount of industry that is just been made obsolete by this remote working environment. And that trickles through the entire economy. It really does.
It does. Yeah, that's very true. Good insights. Larry, do you have any further questions?
No, I think I'm good.
Yeah, this was
pleasure,
awesome,
man.
Jay.
Hope I didn't talk too much.
You did it. This is wonderful. We have tons of great content, and
Good.
thanks for coming. I appreciate
Thanks
it.
for having me. I really appreciate it. It's a lot.
Yeah.
It's a lot of fun. Do it anytime you need me.
Okay, love it, Jay. If you enjoyed this episode, please like and subscribe to the channel, and thank you very much.